Resilience of that supply chains is going to now involve country risk assessment and understanding, which countries you have your supply and those critical supplies located, and looking to see that you can diversify. You either can diversify to a new supplier who's in a country where you don't think there's that high country risk, or you can encourage investment and support that level of investment in order to diversify your supply. So I think that, if you're sitting in the CEO suite, you're looking at these high commodity prices. We're looking at it on an equity by equity basis, and we're really looking at the ability to pass through the pricing. But I don't think that we're holding on to these high prices and assuming that they're going to continue infinitum, because I do think that you will start to see supply come on and those price hikes start to abate.
Katrina Dudley of Franklin Mutual Series. Katrina, thank you. Thank you very much. That headline from Deutsche Bank, let's just return to it quickly. From the CFO, we will adjust our Russia presence along with clients. We'll adjust along with clients. Now, Lisa, that's very different to what we've seen from maybe the consumer goods companies, the luxury items companies, the automakers who have just said, no thanks, we're out. The banks I haven't seen take quite the same stance over the last couple of weeks.
It's hard to know what the implications of that would be given all the financial instruments that are tied to Russia. How do they remove themselves completely when there still is debt to be paid out, when there still are instruments tied to Russian assets? It's a complicated picture, while a lot of companies want to take the moral high ground here, especially because that is what's being demanded of them from consumers. What's being demanded of these banks from their clients, from their consumers?
Yeah, did you see the story in the FT?
Yes.
What PIMCO could be on the line for.
What, $2.5 billion with derivative and cash exposure? And this
the wrong
is what
side
a lot
of CDS.
of people, and how many others are in the same boat, right? I mean, how do we gauge the potential derivative exposure to some sort of event when it's called, which hasn't even happened yet?
Yeah, you've got to define a credit event. Then the call has got to go to the determinations committee, of which PIMCO is a part of, Tom. And I'm not suggesting anything improper. That's not my place. I'm just suggesting this one gets complex quite quickly.
It does, and this is a financial discussion of financial instruments. John, I'm going to be real clear here. There's a commercial aspect as well, which is what Deutsche Bank is talking about. Believe it or not, I've skimmed a PhD thesis on this, John, of JP Morgan Sr. in 1917. It's no different than it was then, is these big banks extract themselves from commercial relationships.
Tom, I can speak for us all. We believe it. We all believe you read that. Futures down 1% on the S&P.
But
this is Bloomberg.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali, sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja, belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
In London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this story.
How are you thinking about those dynamics?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
There is still a deep negative here, which is these high levels of inflation and potentially demand destruction too.
It isn't just oil that's rising, it's natural gas, it's food, it's metal.
It's adding fuel to an already well-kindled inflation fire.
Eventually, we will see the market even out. It was always hard to get inflation calls right. It's even harder today.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
There is no diplomatic breakthrough from New York City this morning. Good morning, good morning. For our audience worldwide, live on TV and radio, alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Futures down 0.9% TK. No breakthrough in Turkey.
Not only no breakthrough in Turkey, but a breakdown in Ukraine. I think, John, as we look at ECB, we look at inflation, maybe we'll even chit-chat Amazon. Guess what? It doesn't matter. The news flow militarily out of Ukraine has been absolutely grim. Yes, the focus of Mariupol on the Black Sea, where Putin wants a land bridge. There's no question about it. But this is about devastation and a reaction to it. And, John, I'm going to go to the shock of Chelsea and Prime Minister Johnson's actions.
We can build on that in just a moment,
Sure.
Tom, but let's go there. Let's compare and contrast the hope in markets about a better future yesterday with the brutal, tragic reality of what was happening on the ground in Ukraine.
It touched in the last hours, and I guess with, Tom McKenzie on the border at Poland and 2.1 million and counting refugees, it's a movement, and I'm not sure, John, yet that it's a movement west. There seems to be real focus on the true adjacencies to Russia, a little bit to Belarus, but it's an Eastern Ukraine story still.
Lisa, this morning, Chancellor Scholz pleading with the Russian leader to deliver an immediate ceasefire.
Everybody wants this to end, at least in the Western world, and yet we don't see any potential inroad there. If Lavrov, the foreign minister, came out and said that ceasefire talks were not on the table with the foreign minister of Ukraine, Kuleba, then what were the purpose of these talks? Honestly, I keep coming back to that because ultimately the ceasefire is the condition to start some of the negotiations for the Ukrainians.
I'd encourage everyone to go back and watch the news conference with the Ukrainian leader. You got the impression, the Ukrainian foreign minister to be specific, you got the impression from that, Lisa, that his counterpart had no control, no authority whatsoever sitting across the other side of the table.
He even said, we hope to arrange serious talks with Ukraine's prime minister, with Ukraine's president, as well as, of course, Vladimir Putin. Well, that means that these were not serious, right? And at what point does Vladimir Putin have enough to go back to his people and say it was worth it to end this crisis without possibly allowing Ukrainians' demands? And this is the quagmire that we remain in.
It's the story of the moment. That's the story of the moment in Europe and around the world. For the market, the attention drifts slightly to 8:30 Eastern time when we get CPI and an ECB rate decision in between. At the moment, futures are down about 1% on the S&P, and the Nasdaq we're down 1.4%. A drift lower after a monster bounce yesterday on the S&P, the biggest move higher we've seen going back to June 2020. Yields at a single basis point at 194 on 10s, and Lisa, a pop again on crude up 4%, 113.50.
The emphasis here really needs to be on the incredible volatility. The yesterday's plunge, the most since 2008. The surges surges, the plunges. People cannot figure out how to understand the new regime we're in, how long this conflict is going to last, and how much that rearranges a lot of the commodities trade market. At 7:45 a.m., we do get that ECB rate decision, followed by Christine Lagarde's news conference at 8:30 a.m. I am wondering what she says about the euro. People have been talking about possible ECB supporting the euro by simply leaving a rate hike on the table, saying, look, we are facing off pretty severe inflation. How much does that become a concern? Because the lower the euro is, the more expensive imports, which just adds to the inflationary pressures. At 8:30 a.m. in the United States, we get the latest on CPI for the month of February, expected to climb to 7.9%. The estimates range within that from a little bit lower to significantly higher, as John Farrow has pointed out. How much does this give us a sense of the momentum heading into this oil shock, into this wheat shock, into this aluminum shock? How much does this really lead to the idea that higher gas prices, it's not just that they're the highest on record in the United States, it's the pace at which they are moving up, nearly $1 increase so far this year. And at 1 p.m., the U.S. is planning to sell $20 billion of 30-year notes. I've been watching these auctions because how do you game out the next 3 decades if we can't even get a sense of what's going to happen in the next 3 days? We have seen the 30-year yield remain in this lower band. It has continued this downward trajectory. Do people see this shock as moving into a new regime of higher inflation, or do people talk about stagflation or stagflationary type of winds that could potentially lower even further longer-term growth?
Lisa, thank you. The guide for the morning still ahead. 2 names I'd like to look at. One in the pre-market, one in Germany. First in the pre-market, Amazon popping higher off the back of the story yesterday afternoon that we will get a 20-for-1 stock split at a $10 billion buyback. That stock is up by more than 5% in the pre-market, off the highs overnight after the close yesterday. Tom, the other story is Deutsche Bank. I think this is phenomenal to come out and say, we'll deliver a shareholder payout of about 8 billion euros. That's the target, not necessarily a commitment. But the target is spread across 2021, Tom, through 2025. Now, can you tell me how you can make that kind of commitment over that kind of time horizon, even given what we're seeing play out right now? How can you even have a forecast for the next 12 months?
The only reason you can do that, and I thought the interview with Guy was very important, the Von Moltke interview, John, is if you're a book value of 0.35, which is basically Deutsche Bank flat on its back, those around you will not survive, or those around you will not prosper, maybe I should say. So their stunning headlines out 3 long years have to be on a game theory basis. Deutsche Bank will dominate. That's the only thing I can understand.
And that stock is down a little more than 3% over in Frankfurt, Germany. We'll catch up with Guy in Frankfurt, Germany, ahead of that ECB decision and after it, and just around the news conference too. The team coverage on Ukraine starts right now with Bloomberg's Jens Fitzpatrick in Washington, Maria Tadeo in Paris. Maria, I'd like to come straight to you. The diplomatic effort this morning, has it failed?
Well, it has in pretty much every way. When you look at that press conference from the Russian Foreign Minister, Sergei Lavrov, essentially this is the same narrative they had 2 weeks ago before the war started. He said there is, in fact, no war. This was a preventive move. He also says that Ukraine is full of ultra-nationalists and Russia has liberated territories that are friendly to Russians. He also said and repeated what has been the new narrative from the Kremlin over the past 48 hours, that Ukraine, alongside the United States, was working on chemical or biological weapons, I should say. He says they have proof now, in fact, that they have obtained from some of the territories, quote, that Russia has liberated in Ukraine. Of course, we know that the Ukrainians say all of this is false, just like everything that Russia has said for the past 2 weeks. And the United States says there were no biological weapons being worked on in the country. When you look at what the Ukrainian Foreign Minister Kuleba said, well, essentially nothing's moving, and for a very simple reason. The man that actually calls the shots is Vladimir Putin, and is not engaging for the time being.
So, Maria, how much pressure is mounting on the German government to change their stance when it comes to oil imports, when it comes to gas imports from Russia?
Well, as you know, today there is a meeting of European leaders that is being led by Emmanuel Macron, Olaf Scholz, who was on the phone, by the way, with the Russians today. But the impression that I have is that come tomorrow, there won't be a full embargo of the European Union when it comes to Russian gas and oil. I think this is very limited. It's not going to happen by tomorrow. And it's pretty clear now that Europe, in particular countries like Germany, have also made it clear it's very difficult for us to switch from one day to another. It is unrealistic. And I keep being reminded of one set of figures. For every dollar the United States could lose with the sanctions, the European Union stands to lose 10. So what they say is they need more time.
Maria, with the time that we have, I have to speak to you of the shattered dreams of Macron in this meeting at Versailles. This is supposed to be an international victory lap amid election for the gentleman from France. As they mention, it is a tectonic change, to say the least. What should Jack Fitzpatrick and others listen for at Versailles today?
Well, it depends who you ask, Tom, but if you ask the French, they won't tell you this is a bad thing for Emmanuel Macron. On the contrary, they'll tell you the president is up in pretty much every poll. He has no competition. The fact that Marine Le Pen was hanging out with Putin for many years is not helping her, and he is being presented now as a father of the nation. So yes, you're right, in many ways, all of the many phone calls he had with Vladimir Putin did not really produce anything. In many ways, you could argue Vladimir Putin repeatedly lied to Emmanuel Macron. We hear personally he's offended by this, but nonetheless, for Emmanuel Macron and the people around him, they feel like this is a good thing. He is on the phone with pretty much everyone, and he is leading international diplomacy, so they don't see this as a lose situation.
Jack, tightening the screws, that is what the U.S. and Europe is trying to do. What's next when it comes to sanctions, when it comes to further actions by the United States?
Well, you know, the White House has pumped the brakes a little bit on pushing more compared to the approach Biden has already been sort of pushed into taking, blocking oil, gas, and coal imports from Russia. There was bipartisan agreement on including a measure in this bill to force his hand to permanently revoke or to revoke Russia's permanent trade status that would allow more tariffs on any Russian exports, but that was removed from this bill that was just passed in the House at the request of the White House. So they're not seeking to do a lot more right now, but again, there's bipartisan interest in Congress in potentially forcing the president's hand, whether it is on Russia's trade status, the sale of gold out of Russia. You know, there's been a lot of talk on Capitol Hill on pushing for more and more, while the White House has said, let's leave a little bit more on the table.
Hey, Jack, good to catch up, buddy. As always, Jack Fitzpatrick there and Maria Tadeo. A long list of sanctions to work through now, including a long list of oligarchs. That list now includes Roman Abramovich, the owner of Chelsea Football Club in the UK, Tom. That news broke out of the UK earlier this morning. And going through the British reporting this morning, Tom, the amount of rules now that Chelsea Football Club has to abide by, because Abramovich assets, including the club, have been frozen. It means he can't sell the club anymore. The sale, I understand, is on hold. They can fulfill their existing fixtures through the rest of this season, Tom. The staff and the players can be paid, but they can't sell new tickets. The merchandise shop has to be closed. And from what I see in the reporting, there are limits on how much they can spend to attend away games as well. This is going to get really difficult, Tom, for that massive football team out of the UK.
And the players have to step on the field. You wonder how they will feel.
And how many will leave, Tom, this summer. Futures down 9/10, call it 1% on the S&P, on the Nasdaq down 1.3. From New York, big morning still ahead, CPI just around a corner. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The latest attempt at diplomacy in the war in Ukraine appears to have gone nowhere. The foreign ministers of the two countries met in Turkey in their first discussion since the war began. Ukraine's foreign minister says Russia indicated it would continue attacks until its demands are met, and one of those demands is surrender. The UK has added 7 more prominent Russians to its sanction list, including, as you were discussing, the owner of the Chelsea Football Club, Roman Abramovich. They face a full asset freeze and a travel ban, plus they are prohibited from doing business with UK citizens or businesses. The move effectively derails Abramovich's plan to sell Chelsea. And the U.S. House has passed a spending bill that funds the U.S. government and provides $13.6 billion to respond to the war in Ukraine. The money will help pay for weapons and aid to refugees. Lawmakers from both parties expect more funding eventually will be needed. And Goldman Sachs is Out with a dismal forecast for the euro area economy in the second quarter. Goldman expects economic output to shrink because of the war in Ukraine. Meanwhile, analysts say inflation is likely to climb towards an 8% handle. General Electric reaffirmed its financial goals for this year despite volatile markets. GE says profit margins will expand. Adjusted earnings will be in a range outlined in January. CEO Larry Culp is preparing to split up GE into 3 independent companies early next year. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The first step in building a connectome is to get your hands on some brains and then cut them up. It all sounds very grim, but Harvard turns out to be quite efficient with its brain harvesting. Jeff's lab can do a year's worth of research with a single mouse brain. Small chunks of the brain are fed into the slicer, where a diamond blade carves off a thin sliver of tissue. The tissue floats along some liquid and onto a piece of tape. The brain slices are then put into this very large machine, where they're photographed in the finest of detail. Software helps stitch the pictures back together into a single 3D image, and algorithms are applied to help make sense of what's going on inside of the brain.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Wall Street prepares for the latest read on inflation.
It's going to be a big number.
We are drowning in uncertainty.
Economists predict the highest numbers in 4 decades.
Many estimates now have an 8 handle in front of it.
Not even including gas.
Instant reaction.
Keep an eye on the resiliency of the consumer.
It's not a question whether we get a recession. It's like, what kind of recession are we going to get?
And what it means for the Fed.
This trend is no friend to the Fed.
Do we lead to a slower growth kind of paradigm?
They're going to want action at the White House.
Inflation in Focus, Thursday morning at 8:30.
Doskonale zdawałem sobie sprawę z tego,
Happening right now, a news conference live, a joint news conference with Vice President Kamala Harris and the Polish President Tom, happening in Poland today. The diplomatic effort continues.
This is about jets. And overnight, John, I don't have the exact citation in front of me. Basically, the United States said, no, we're not going to move jets around to assist Ukraine. You've got to believe that was at the top of the pile of this discussion.
Tom, what did you make of how publicly that diplomatic dispute, if you will, played out in the last couple of days?
I just think it's an example of a fractured ally group with everybody trying to keep it together against one singular force, which is Vladimir Putin. I mean, that's what this comes down to, and we've seen it many times in history. How do you offense against a singular force, and the force that we've seen in the last 24 hours in Ukraine, and I like what Lisa says about it. This is spiraling. I mean, that's where we are this morning.
Well, Lisa, let's talk about that. The Vice President moments ago saying ongoing talks with Poland about sanctions going forward.
The fear right now is poking the bear a step too far, right? I mean, nobody wants to seem like they are escalating the conflict because there is this potential for a conflagration of even larger scale. And that was what Peter Trubowitz was saying, that this has the potential to really spiral downward, and no nation wants to be responsible for that. And that is what it exemplifies to see this spat playing out in public.
Is the dialogue working? Is it stopping it from getting worse, perhaps? Is it making it better? Not quite, Tom. There was a call this morning between Chancellor Scholz, President Macron, and Vladimir Putin, a Russian president. We've had the readouts, so to speak, from Scholz's office. Tom, Germany and France called for an immediate ceasefire. Macron and Scholz insisted that any resolution to this crisis must come through negotiations between Ukraine and Russia, and the three leaders ultimately decided to stay close in contact with each other over the next few days. It's falling, Tom, at the moment on deaf ears.
I went back to Aggie Cantrell in Europe, leading our coverage on this, and I said to Aggie, I said, what did Putin say? And do we know what Putin said in that conversation, John? I don't think we do.
Well, did you see the pictures of Emmanuel Macron in his office after making a call with Vladimir Putin in the last week, Tom?
Yeah.
I think you can get an idea from those pictures as to what he said.
Futures stable now, negative 36. The VIX up a stick, backs up from the big day we had yesterday. We are covering this war with our team in Europe on the Polish border as well. But there are other issues going on, including an ECB in this hour, the Lagarde press conference, and of course, an important U.S. inflation report. We try to do what we do with Lori Heinel today, Chief Investment Officer, State Street Global Advisors. Lori, I love in your note, you go to the heart of the matter. It could be now, maybe, not to instill fear, but it could be the late 30s in Europe. How do you diversify amid war? How do you do that?
Well, look, it's really challenging. And I think that the first thing I would say is that this war is just exacerbating trends that we were already seeing. There were already concerns about slowing growth. Certainly the Omicron at the beginning part of this year put a little bit of damper on that. We were already seeing high inflation prints, and we already had a Fed in play that was preparing to get off of the zero bound. So those trends were already happening, and this war just intensifies those. So one of the primary ways that we've been focusing on that is focusing less on the directional trade, i.e. significantly overweight equities, and much more on diversifying those exposures across different regions. And then adding things like gold and even long bonds, long treasury bonds, that is, to be able to dampen any sort of, tail risk event.
Lori, we've seen these huge swings in markets. Yesterday, a lot of people attributed the gain that we saw across equity assets just to simply optimism of some diplomatic resolution. And yet, when we talk to big investment managers, they all say they are just sitting on their hands and waiting, perhaps staying in a little bit more cash. What do you make of who is actually trading on any of this amid a sea of uncertainty as a lot of the big players just try to assess the landscape?
Well, look, the fundamental backdrop is still pretty attractive. We're seeing our earnings forecasts actually being ratcheted up, particularly in the U.S. And as I mentioned, while the growth story is slowing a bit, we're still expecting well above trend growth. Here in the U.S., for example, around 4%, which is about 1.5 to 2 percentage points above trend growth. So with the pullback in the markets, there actually are pretty attractive entry points here. I guess the question is, what's your time frame? Because if your time frame is a day, then you could quickly reverse that move. But if your time frame is a bit longer, we know that wars, as terrible as they are, they tend not to impact the longer term trajectory.
Lori, how much do you actually pay attention to any of the data, like the CPI print that comes out at 8:30, given the quickly moving backdrop? I know that it feels like it's going to last forever. You say it's temporary. How do you even gauge out the relevance of some of these numbers?
The delicate balancing act is the print today versus what does that imply about the future. And in a perverse way, higher prints now actually take a bit of the pressure off of 2023. And given that we are in a war scenario and that a lot of these inflationary pressures are being exacerbated by that, we actually expect the Fed to look through some of that a bit. So in one sense, we think that these higher prints may mean that the Fed actually doesn't have to respond because it's much more about the moment versus the longer term and what they need to do longer term to contain that inflationary pressure.
Fed decision next week. Lori Heino, thank you. Joining us from State Street. Lisa, the real test in the summer. The base effects start to kick in the opposite way to the way they kicked in last year. That's when we start to see just how much this story is going to fade.
Well, but that was including what people thought would be a roller go. Do you see a difference in the base effects that don't come through the way that people thought?
A change of tone from the administration as well, Tom. Secretary Granholm yesterday. Did you see those comments to the oil producers?
Yeah, I skimmed those.
Pleading with them to pump more. In fact, thanking them for their effort over the last century or so.
Right.
To help this economy.
I gotta walk delicately here, because out on Twitter there's a moment I had with the secretary a number of months ago with great respect for public services to Michigan. And John, it's just a clumsy moment into the great credit of the administration. They're trying to get a read on it amid war. And the word I would use, John, is clumsy. Everyone, I don't mean that in a negative way. It's just a really clumsy moment for leadership in America.
Well, I think the previous interview that you're referring to, Tom, was also clumsy, incredibly clumsy for that matter. And in fact, I think in many ways it still haunts the administration as well. The about-face that they've had to pull in the last 3-4 months, Tom, on crude in this energy transition.
I think everybody's certitudes, John, have been shattered here. Republican, Democrat, it's equal opportunity. I mean, has the same thing happened, John, in London with Labor? I mean, we're a long way from Mr. Corbyn, aren't we?
I'm not sure they were laughing about gas prices, Tom.
No, I don't think that. I think they've done better than here. Absolutely. They're not making jokes about a gallon of gas in London.
No joke to make about it. Futures down 0.8 on the S&P. On the NASDAQ, down a little more than 1%. From New York on TV and radio, this is Bloomberg.
Omicron variant and the latest wave have an impact on not only consumer trends, but your business? And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
We're looking for a diplomatic solution, and right now, there is not one to be found. We had a news conference this morning from the Ukrainian foreign minister, from the Russian foreign minister. Those two were happening at the very same time. No breakthrough. No breakthrough, and then Chancellor Scholz, Emmanuel Macron getting on the phone to Vladimir Putin, pleading for an immediate ceasefire. No breakthrough there. Futures down 0.8% on the S&P, and this follows a big bounce yesterday, the biggest one-day pop on the S&P 500 going back to June 20, for the Nasdaq 100 going back to March 21. The Nasdaq right now negative more than 1%. That's the story in the equity market. Here's the bond market, 2s, 10s and 30s. 2s very close to the highs of the year at 168. 168.21 on 2s right now, 10s at 195. That curve has got flatter. That spread between 2s and 10s has got tighter. Going into CPI a little bit later this morning, 8:30 Eastern, 1 hour from now. The estimate's 7.9%. And some big names that you know from this program looking for an 8 handle. NZ and Morgan Stanley being one. We'll catch up with Morgan Stanley in just a moment. Mike Feroli of JP Morgan being another. They're looking for an 8 handle in 60 minutes' time. We'll bring you that report. Let's finish on the ECB and Europe. And think about Europe as follows. The ECB stuck between a rock and a hard place. If they move away from doing anything anytime soon on interest rates, the euro is in trouble. And it has an inverse correlation with crude at the moment. That's the inflationary spiral that Deutsche Bank are talking about. If they make a move to do something about it, lean the other way, raise interest rates maybe at the back end of this year, then all of a sudden, Tom, Italy might be in trouble. Your Italian 10-year at 170. And Lisa, that is the problem for the ECB. This is a really, really fine line to try and walk through 22.
Which is the reason why a lot of people are looking to Christine Lagarde to give some guidance on how much she's watching the euro versus concerns about keeping borrowing costs low on the periphery. Because honestly, if the euro keeps losing value and keeps depreciating versus the dollar and other currencies, how much do they exacerbate the inflationary pressures in the euro region?
Euro dollar 110.42, Brent crude 116. Brent up more than 4%. That's across asset price action. Some single names this morning. We can say good morning to Romain. Good morning, Romain.
Hey, good morning, John. Of course, as we await that CPI report, keep an eye on some of the individual names, including Amazon. We talk about the big tech companies out there, the ones that were in that 4-digit club with regards to their stock price. A 20-for-1 stock split announced last night. Combine that with a $10 billion buyback, and you get a little bit of a pop here in the stock on this day, up about 5%. But certainly keep an eye again on that CPI data. That'll actually probably be a much bigger driver for some of these stocks, depending on whether that beats to the upside or disappoints to the downside. Alibaba and a lot of the Chinese ADRs also moving lower here. This, of course, on the back of a really wild day over in Hong Kong. We actually saw that Hang Seng Tech Index up more than 4% on the day. Basically, though, end of the day, relatively flat for most of those names here. That volatility now trickling over here into the pre-market session. And PayPal and some of the payment stocks, which had a nice little rebound the last couple of days after a 7-day slide, pulling back just a little bit as as there's still a lot of concerns here about international payment flows because of the war in Ukraine. CrowdStrike higher here on the day, up about 13% on the back of earnings, a beat and raised quarter. And Asana, the big software maker, down about 25% right now after it missed on its guidance. And after the bell tonight, Tom, we're going to get more earnings. Rivian Automotive coming out, less concerned about the earnings, more concerned about those production targets.
I expect to see another 20-to-1 stock split on the close tonight with Romain Bostic. We'll see. There's a few of those left to be had, I'm sure. Right now, and again, we're continuing to monitor the flow of diplomacy and international relations and war out of Ukraine. We touch on the news at hand in our world. Seth Carpenter joins us, Chief Global Economist at Morgan Stanley. Seth, I got 8 ways to go here, but I'm going to go back to your days at Princeton where you were forced to listen to Alan Blinder, a great friend of the program. I think he's in his 400th edition of his classic economics textbook. Alan Blinder stopped Jackson Hole 10, maybe 15 years ago, I can't remember, with a paper on understanding Alan Greenspan's calculus. And the one word is measured. In a war, can a central bank afford to be measured, as Alan Greenspan chose to lead with?
That's a great question, Tom, and great that you mentioned Alan Blinder. He's actually part of the reason I became a macroeconomist. I had him first semester, first year of graduate school. Can a central bank afford to be measured? I think the answer in the short run is yes. And in some sense, it's probably what they have to do. So if you take a look at the Fed right now, this adverse shock, even if we put aside the horrible human toll on it, there is a clear adverse price shock to the United States, to other developed economy. I can hear you.
We can still hear you, Seth. Can you hear me okay?
Thank you very much. Yeah.
Carry on, Seth. Carry on.
Your control room broke into.
They just wanted to chat. They were so fascinated with what you have to say. Carry on, Seth, please.
Very good. Excellent. Yeah. So it's clear it's going to exacerbate inflation, and it's probably going to have an adverse effect on real growth in the United States. We've revised down our forecast by about 40 basis points. But right now, the Fed wants growth to slow some. They think it's growing faster than is sustainable, but they don't want to overdo it. And knowing where that line is between doing enough to slow the economy and doing so much that you overdo it is very, very murky right now. So I think they have to go in an initial step of 25 basis points. After that, I think it remains open, as Chair Powell told us last week in testimony.
How relevant is the Fed at this point, Seth? And I ask because the pace of the increase that we have seen in gasoline prices, the pace of the increase in a wide swath of commodities is leaving a lot of people trying to assess the damage. Has it gotten away from the Fed, regardless of what they say or do?
So no, not necessarily. I think the Fed's very relevant here. The challenge, of course, is what is going to be the lasting effect of the oil prices. I think, Lisa, in the previous segment, you pointed out that people were looking for the base effects and inflation to come off, partly because they were thinking gas prices would be rolling over and rolling out of the calculus. That has clearly changed. And so as we've revised our inflation forecast across the globe, it's not only raised it to a higher level, it's also pushed out the timeline for when we start to have the inflation coming down. So that matters a lot. It makes it harder for central banks to know exactly where the underlying run rate of inflation is going to be. But nevertheless, I think the Fed sees it very clearly that now they want to get going. Where they end up, I think, very much depends on how this whole Russian invasion of Ukraine plays out over time.
Seth, I want to understand from your perspective now how this inflation story hits consumption. To what degree it weighs on discretionary spending for the American consumer. Have you done that calculation yet based on the lift we've seen in crude, the lift we've seen in food prices?
Yeah, we've definitely been looking at that, and the key part of that analysis is to think about the income distribution in the United States. The higher prices do not hit American consumers equally. If you're in the lower fifth of the income distribution, you've got between 5 and 10% of your discretionary income going to energy. That's going to be a really painful hit to the pocketbook for a lot of Americans who are at the lower end of the income distribution. I think that matters a lot.
Seth, when you look at the lower end of the distribution, it comes down to public policy amid crisis. Would you look for an activist policy by the Biden administration, including some sort of rebate on high gas inflation?
I have complete confidence that there are folks in Washington scrambling right now trying to assess what it is that they can do. To say the least, politics right now is difficult given where inflation is. But we have seen those sorts of policies in other countries. Europe clearly comes to mind. So I very strongly suspect they're trying to figure out what is it that they can do that on the one hand gives relief to American consumers, but on the other hand does not exacerbate the inflationary situation.
You know, there's a theory out there, Seth, that the higher prices will bring more people into the labor market, that we'll see the participation rate go materially higher, and that will actually bring down inflation because the supply, the pool of labor will grow. Do you subscribe to this theory?
So I don't know that I'm a big fan of that being driven just by the inflation, but what we can see, especially if you look at prime age labor force participation, that has been trending up over the past year. It's up by about a percentage point. We see that cyclical pattern in labor force participation in every cycle. So I have every confidence that labor force participation is going to continue to grow, but that for me is primarily a cyclical phenomenon. What I'm thinking about with these high oil prices, and this is also something that you all touched on in the segment before I was on, is what happens to oil production in the United States. We have seen in 2015 when oil prices collapsed, we saw a collapse in production in the United States. In 2016-17, oil prices rose again. We saw an increase in oil production in the United States. Now, this time is a little bit different. Oil companies are a bit more careful about what they're doing with the cash flow. But as you mentioned before, the administration has been talking to energy companies. Energy companies have given some indication that they will try to ramp up some of that production. So in an interesting, maybe counterintuitive way, there's a short-run potential stimulus to the higher oil prices through extra production in the United States.
Seth, the control room wants to know if today's print is as bad as it gets at 8:30 Eastern Time.
Gosh, fingers crossed. I hope so, sincerely. I think the wild card is going to be for headline what goes on with oil. But when it comes to core, we are thinking that we're sort of around the peak and hopefully things start to come off from here.
Interesting. Good to catch up, Seth. As always, you're a good sport. Thank you, sir. Seth Carpenter there of Morgan Stanley. Looking for that number to come at 7.9%. The headline number, year over year. Ex-food and energy, 6.4% from 6% previously. Still a punchy number, Tom. The number about 50 minutes away.
Long ago and far away, I had a wonderful talk, John, with one Lawrence Kudlow about this. The conceit of economics of given rising inflation to ignore core inflation that every single listener and viewer has to pay. I got a couple emails on this morning, John. And, Dr. Carpenter's the real freaking deal. Let me be honest about that. I don't question his focus on core or untrimmed, on Dallas or Cleveland. I'm just saying not one single person watching or listening to this, John, buys it.
I know why policymakers have to do it, but I totally hear you. Lisa, if you're sitting there at the gas pump watching the prices go up, and then the economist turns around and says, well, we stripped that out, and this is why it doesn't matter, and food prices,
Well, there was actually a survey the American Psychology Association put out, and stress in America is actually really high. I know this sounds like it's sort of esoteric and it pales in comparison, but it really feeds into sentiment and then consumer spending and speaks to the moment of crisis after crisis.
Bramo, on top of things, as always, as you'd expect, Tom.
She's far and wide. You and I are focused on 4 decimal points, and she's actually looking at what matters.
Futures down 0.9% of 1% on the S&P. The Nasdaq down 1.3. Euro dollar going into this at 110.37. Your ECB decision is moments away. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The Russian army's unexpected struggles in Ukraine are raising questions about just how good it is. Vladimir Putin's troops have been bogged down and have failed to take control of key cities. Reports of poor troop morale and organization echo past weaknesses. Observers also are puzzled as to why Russia hasn't used its air power more. The U.S. House has sent a signal that both parties want stronger punishment for Russia for the invasion of Ukraine. By an overwhelming majority, lawmakers approved legislation barring U.S. imports of Russian oil. The vote came a day after President Biden used an executive order to ban Russian crude imports. It's not clear if the Senate will take up the bill. And Bloomberg's learned the Biden administration may impose sanctions on Russia's state-owned atomic energy company, Rosatom. Rosatom is a delicate target because the company and its subsidiaries account for about 35% of global uranium enrichment. It has agreements to ship nuclear fuel to countries across Europe. And the CEO of the Bank of New York Mellon is retiring after almost 3 years. The bank announced today that Todd Gibbons will be replaced by Vice Chair Robin Vance. Bank of New York Mellon is the world's largest custody bank. It tracks assets and performs other services for money managers and financial firms. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
If Putin is not stopped in Ukraine, there will be terrible implications for European and global security. We must go further and faster in our response. We must double down on our sanctions. That includes a full SWIFT ban and the G7 ending its use of Russian oil and gas.
Liz Truss there, the British Foreign Minister. From New York City, futures down 0.9%. Your headline this morning, CPI, moments away, 8:30 Eastern Time. Before we get there, we get a decision from the ECB. Would you like to whip through the price action? Futures down 0.9% on the S&P. On the Nasdaq 100, we're down by 1.3%. Looking at a euro, weaker going into this one. Euro dollar looking a little something like this, at 110.37 and down 1/3%. You will remember the middle of February, we came very close to 115. We have backed away since then. And this inverse correlation between crude and the euro has developed. That's a problem for the Europeans. Crude at 113.25, up a little more than 4% this morning. And an ECB, Lisa, that has a very, very fine line to walk.
It needs to help support the recovery, particularly in the recovery in the periphery, while also not encouraging inflation to go further with that weak euro.
Typically what happens here is we have to wait a couple of moments for an ECB decision. It rarely ever comes out exactly at 45 minutes past the hour. Then we'll go through a bunch of headlines. In the news conference, we'll try and get an outlook from President Lagarde. And President Lagarde, I think, Tom, is in a tough position right now to communicate the year ahead. Here's the decision, Tom, unchanged at the ECB at 0. The marginal lending facility also unchanged at 25 basis points. The depot rate at -50 basis points. The ECB saying the Russia invasion is a watershed moment for Europe. Net buying under the pandemic program will end in March. We will ensure smooth liquidity conditions. They leave rates unchanged, Tom, and they will reinvest the maturing PEP bonds at least through the end of 2024. To conduct APP at a pace of 40 billion euros a month in April, they dropped the wording that rates could be lower than currently, a bad time in the minds of many people. They announced a faster winding down of the asset purchase program. They conduct APP at a pace of 30 billion euros a month in May. So that's the headline that I see right now at the moment, announcing a faster winding down of the asset purchase program, which in a way gives them the flexibility to raise interest rates if they need to at some point. Off the back of this, the euro firmer in positive territory, euro dollar at 110.87. The ECB saying they will take whatever action is needed to fulfill their mandate. Just a little bit of a lean there, Tom, into the inflation print recently.
John, let's compare and contrast their mandate, starting with fractious Europe and fractious set of nations versus the Fed's mandate. These are different mandates, aren't they?
The calibration of bond buying in the third quarter will be data dependent. Any rate adjustment will be gradual. What has happened in this meeting today? Because there is a shift here at this ECB that some people thought was off the table, given what has taken place in Russia. I want to get straight to Guy Johnson and get his views. From Frankfurt, Germany. Guy Johnson, you've heard the headlines. Your thoughts?
The Eurozone faces two problems, John. It has a growth shock, which has been caused by Ukraine, and it has an inflation shock, which has been caused by a multitude of factors, including Ukraine, but supply chains, all kinds of other things into the mix there. You take a look at the 5 years over the last few days, they've gone through 2%. That is a key indicator for the ECB. You've got German break-evens at records. I appreciate that German inflation has been higher over history, but since break-evens existed, they've never been this high. The ECB has an inflation problem, and as you guys have just discussed, its mandate is inflation. I think basically what is happening here is that the ECB is going to focus on the inflation side, and it's going to leave the growth shock to the fiscal side. The ECB can do very little about this supply-side shock, John. There's not much they can do about this oil shock. So effectively, they have to leave it to the fiscal authorities to be able to manage that. We're already starting to see that happening. I would look to Versailles for more action on that front. From the ECB's point of view, they are way off target in terms of the inflation narrative. I'm looking forward to see the star projections in terms of how they see inflation coming down. Yeah. The ECB's still in camp transitory, but it looks like transitory is going to be pushed back a little bit, and ultimately they have to deal with this problem, and it looks like they've decided to grasp the nettle, John, and deal with it maybe a little earlier than the market was anticipating.
I'm looking forward to the growth outlook as well at 8:30 Eastern time, so in about 42 minutes from now. Guy, looking at the price action, front end of the Italian curve, BTP is now up 9 basis points on an Italian 2-year. The euro very, very briefly punching through 111, right now 110.98. Guy, this idea that they may end the asset purchase program in the third quarter, would you stress this is about optionality or setting the path forward to go ahead and raise interest rates before year end?
I think there's probably a little bit of both in there, John, but Bloomberg has been talking to various members of the Governing Council over the last few days and weeks, on and off the record. The objective is to end the extraordinary monetary policy that we've seen over the last few years. They are heading towards the exit on that front. It was always just a question of pacing and calibrating. I think what has been made clear here today, John, is that that is very much the focus. We are on track to deliver that. I think the timeline is a little bit more advanced than maybe people would have anticipated. So, yeah, I think there probably is some optionality in there, but they've laid out quite clearly in terms of the way that they're going to be tapering off that APP program, which I think is interesting. They're making it clear how that exit is going to happen. They're trying to be as transparent maybe as they can at this point. I think given the geopolitical events and the backdrop, I think that's quite hard. But I think there's more transparency here than I would have anticipated. There's more clarity here than I would have anticipated.
I'm with you, Guy.
In the way that this is going to work. But yeah, roll off the QE program and head towards the exit when it comes to rates. Start to lift those higher.
Thank you, Guy. Looking forward to catching up a little bit later. Guy Johnson out of Frankfurt, Germany. There is an additional headline here that I think is important too. So let's think it through. The APP could end in the third quarter. That's just the asset purchase program. There was a pledge to end APP shortly before raising interest rates. They've now dropped that pledge to end the asset purchase program shortly before an interest rate hike. So, Tom, that gives you the opportunity, if indeed you want to take it, to end QE in Q3 and raise interest rates at the same time.
Well, yeah, they're two separate realities, and I think, frankly, John, it's a startup for what we're going to see March 16th as well. And the balance sheet dynamics can be what it is, but what I'm going to listen for from Lagarde is the country or regional parts of Europe discussion. She's got to give color to that. And, John, you see it within the inflation disparity of Europe. I mean, we don't talk about the inflation of California and the inflation of Colorado. Guess what? Spain, 5.5%, Sweden, 3.2%. That's the tension of these announcements.
The 2-year yield in Italy, Lisa, up 12 basis points.
Basically, this is a lot more hawkish than people had expected. It is clear they are worried about inflation, and they are going to target that ahead of providing more relief in the face of this Ukrainian crisis. Yields across the world, actually. You could see over in the U.S. as well, 10-year yields shooting higher as well.
Very quickly, Nick Benenbrook joins us. To say he's international economist at Wells Fargo doesn't do justice to his superb ability on foreign exchange. Nick, I've got to go there. An ECB announcement and such. What does it do to euro?
We're probably looking for at least maybe another cent today. I mean, we could get up to sort of, I know we're close to 111. We could get as close as 112 because it is a very significant surprise today. And as you've rightly pointed out, probably much more hawkish than expected.
Nick, you said it was a very significant surprise. What do you say? What are you thinking in terms of recalibration of the ECB's response function to the inflation that we're seeing, as well as the Ukrainian war?
Well, I mean, they were stuck between a rock and a hard place. We had expected them to, signal that they wanted to taper their purchases, and we were looking for an accelerated tapering into this meeting, though it was probably even quicker than we had anticipated. And so, we think they're still on track to end it in Q3 and raise rates in December of this year. And really, looking at those inflation numbers in the Eurozone, they're probably going to get as high as 6.5% to 7%. The base effects aren't helpful. And really, I don't think the ECB has much choice but to do what a lot of the other central banks have done and respond to those inflationary pressures.
And Nick, I wonder if they can just emphasize a little bit more on the direction of interest rates if they do indeed start to hike. Is there a benefit to saying we need to get away from negative rates and get back to zero? And perhaps not start a discussion about anything longer than a 12-month rate hiking cycle. Is that something in the mix?
I don't know if they'll be quite as precise as that. I mean, to your point, and you made a good point about that pledge on the timing of interest rates. It means they could raise interest rates immediately. If they wanted to, it probably means they could also wait a little longer if that way they were so inclined. I think they'll be a little bit more generic and just essentially say that this is a normalization of monetary policy, and markets will be, very much interpret that as saying, look, the benchmark is to get to zero. We'll worry about anything else that happens after that.
8:30 Eastern, 40 minutes away. We hear from the ECB president. Tom's looking for the outlook. Nick, I want to understand the outlook for GDP. Are we about to see inflation rate forecasts up and forecasts for GDP down? Is that what we could see in 40 minutes?
Yes, I think very much so. Our own forecast, for example, we're looking at 3.8% GDP growth for the Eurozone this year, but we're sort of reassessing, reviewing as pretty much everyone else is. And that could go down by 0.5%, maybe 3.25% with everything that's going on in Ukraine. And then those inflation peaks, as I mentioned, you could see a peak as high as 7% because, not only have you have those unhelpful base effects from early last year, now, of course, you have this surge in oil prices as well. So sharply higher inflation forecasts to look forward to.
Nick, fantastic. Nick Benenbrook there of Wells Fargo. So the stage is set. The market's going to bring forward ECB rate hikes. This is how things could change at 8:30, and I think this could be interesting. When they drop the pledge to end the asset purchase program shortly before an interest rate hike, does that mean they can hike rates earlier or later? Now, I wonder how they use that little clause there as an opportunity maybe to emphasize that, Tom, they'll be data dependent and we just don't know. But the goal is to get out of asset purchases by Q3.
This is not the gnomes of Zurich, John, but I really wonder, was it the gnomes of the Bundesbank speaking this morning?
I wonder what happened in that meeting, Tom. I do. I also wonder how much clarity we'll actually get in the news conference. Overwhelmingly, the consensus view was that they'd have to take a step back from any kind of plan to raise interest rates and wind down QE anytime soon, based on the events in Russia. But the inflation story, Tom, we're close to 6 in Europe now. It's a problem.
To the two of you, this is never boring. I really thought this would be a walk, and this was not a walk. I mean, it's amazing to see, John.
So 8:30, Tom, in 35 minutes, Lisa, we'll get CPI. Then we get a news conference with President Lagarde, and in that conference, we get the outlook, some of the forecasts, all of that happening at the same time.
And right now, what the central bankers are trying to do is maximize flexibility, which gives the, frankly, markets very little guide to go on. The Fed put, the ECB put. Can we say officially that it is dead?
The Italian two-year yield is up 14 basis points on the day now. Your euro is stronger by 1/3 of 1%. It was negative. Euro dollar 1.11. Look out for the banks. Look out for the outlook in Europe. All of that coming up in the next hour. From New York, this is Bloomberg.
Welcome to a special BNP Paribas Open update for Bloomberg TV and radio from Tennis Channel. I'm Johnny Ray Diaz. Allison Risk got off to the perfect start as she took out compatriot Katie McNally in straight sets. After taking the opener to love, the U.S. Fed Cup star closed out the win 6-3 after an hour and 21 minutes on court.
Not only is she a good tennis player, she's a great person, and I love the way she carries herself on the court. So there's only good things to come for Katie. It's always tough playing, I think, just another American. We are friends with pretty much everyone, so it's challenging, but I'm thrilled to get through, and I'm so happy to be playing back here at Indian Wells.
Later, Australia's Ayla Tomljanovic needed 3 sets to dispatch American Haley Baptiste. The Aussie just had too much for the 20-year-old in the decider, closing it out 6-2. And don't forget, Tennis Channel Live kicks off our extensive daily live coverage from the 5th major. It all starts at 10 a.m. I'm Johnny Ray Diaz.
you. It sure is great to be here and talk with you. I love meeting new people. I love making new
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
David, you just hit the nail right on the head.
from businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
However you get your
This
news.
is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think things will stay volatile from here, and it's difficult to see a very short-term sharp bounce.
An investor has to be cautious of this ever-increasing trend of higher and higher prices.
For all of that volatility, we're actually not in that different of a place.
There's opportunity being created here.
If earnings grow this year and people believe they can still grow next year, the market's going to recover, handsomely from these levels.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, Tom Keene on radio and television. An extraordinarily interesting Thursday. Much to talk about of a war in Ukraine. Grim news on the battlefield. Diplomacy, unclear, if not grim. And then, John, I think we need to move away from that just for a second to the shock in Frankfurt.
Winding down QE, Tom, perhaps by Q3, and introducing the prospect of an interest rate hike as well. Dropping this pledge to end asset purchase programs shortly before raising interest rates. Now, the market's reading that potentially as an earlier hike from the ECB. I think that needs clarifying, so look out for the emphasis from the ECB president. That's in 29 minutes, Tom, at the same time that we get CPI in America.
No one's on the same page in this war in Ukraine, including the failed diplomacy in Turkey today, John. You wonder in the press conference of the ECB if Christine Lagarde spins that everyone in Europe was on the same page on this decision.
I wonder if they're on the same page in that committee meeting at the Governing Council in the last couple of days, Tom. I wonder, and hopefully we get some insight on that. For the path forward, today, do we get an increase in inflation forecasts and a decrease, a cut in growth forecasts? And it's the stagflationary winds that Mohamed Al-Erin would say is the big concern right now for Europe.
And Lisa, what's so interesting here is Spain. I did Spain and Sweden. Inflation's so different. We don't talk about California and Colorado with different inflation rates. We see that at 8:30 as well.
Yeah, this basically is leading to a changed reaction function from the central banks. Typically, when there was turmoil or a crisis, you count on central banks remaining easy with their policy. That has shifted. We thought maybe the ECB would potentially keep that up given some of the slower growth expectations? Not so much. So what does that mean for just how much pressure is on the Fed?
The roulette wheel of Asia is the Kospi. The roulette wheel in equities in Europe is the DAX. And John, you focused on the fixed income roulette wheel, which is Italian yield.
Italian yield's up 17 basis points, Tom, to just north of 16.
What does that symbolize?
The 2-year up that much, Tom. Bit of a problem if it continues, that's for sure. And this is why we said the ECB stuck between a rock and a hard place. They want to lead into the inflation story a little bit. At the same time, they've got Italy. They've got Italy breathing down their neck as well, the Italian bond market. That's a tough one to balance, Tom, and that's the big challenge for an ECB this year and beyond.
We'll see this, and all of a sudden, for all of you on radio and television, 8:30 becomes eventful. Michael Gape and Barclay scheduled to be with us on American inflation, and then we'll go to our coverage of Christine Lagarde as well. John, on a truncated data check today, a bounce off of the huge equity market yesterday. We pull back futures at negative 47.
Futures are down a little more than 1% on the S&P. Your Italian 10-year yield is climbing. So is your 10-year in the US as well, up a couple of basis points to 196.89. And crude right now, Tom, 112.32, up more than 3%.
We get lucky. Daniel Morris joins us, Chief Market Strategist at Paris BNP Paribas Asset Management. We're thrilled he could join us off of what all of a sudden is an important ECB decision. Daniel, what is the level of shock at BNP Paribas over this announcement from the ECB?
The ECB traditionally has been quite cautious. You don't anticipate that changing given the uncertainties in the environment. So we think they're going to signal, the end of quantitative easing programs, a change in the parameters of the ones that remain, so they can signal that they're going to still provide support. Certainly try to talk down the market's expectation for rate hikes this year, and hope to the degree that they're able to provide as much stability for an environment that we appreciate is not particularly stable at all.
Looking ahead, they dropped this pledge to end asset purchase programs shortly before the interest rate hike. The initial read, Dan, including my own, was that meant an earlier interest rate hike, perhaps at the same time as dropping the asset purchase program in 3Q. Do you think we might have misread that on the initial read, Dan, and we'll get some clarification in about 25 minutes?
Well, of course, what you're trying to assess is to what degree the central banks should change their original plans for the year, if at all. And it's interesting if you look at overnight index swaps and what those estimates are for the level of policy rates, both in the U.S. and for the Eurozone for the next year. There's been volatility inevitably, but really the level isn't fundamentally any different than it was 3-4 weeks ago. So given that on one hand, of course, we appreciate we have more inflation, but we have slower growth. So what should they do in terms of policy rates? And the market has come to the conclusion it really doesn't change anything. They're going to more or less be on the same path, highlighting caution, highlighting watchfulness, but otherwise I think we still anticipate, certainly in the U.S. And frankly in the Eurozone as well, to have in aggregate tighter monetary policy conditions.
Just reading the statement, Lisa, any adjustments to the key ECB interest rate will take place sometime after the end of the Governing Council's net purchase under the APP and will be gradual. Need to hear from the President herself in about 24 minutes.
Especially because there were other tea leaves that pointing to the same kind of hawkish tilt, also removing language saying that rates could go a lot lower. I do wonder whether this is a substantial shift in light of the inflation. Dan, what does this mean from your perspective in terms of the reaction function of central banks? Has it changed where a crisis that causes a risk-off move in stocks, in risk assets, is no longer met with central bank easing?
Well, that's, I guess, what's different this time. We have crises, we have geopolitical events. This one is more challenging for the central banks to the degree that it is clearly inflationary in a way that other ones are not. So it, to some degree, removes that potential for the central banks to ride to the rescue the way they have done so often in the past. So that's the dilemma. That's what not only the dilemma that they face, but the dilemma that really all investors are facing now as they try to assess, where should they be allocated.
Daniel, I want to go to the unspoken here, and it's really important. I'm going to give great credit to Joe Stiglitz at Columbia University, the laureate, for talking about the small g, which is the growth rate. Europe doesn't have the growth rate that is afforded in the United States of America. With this war, and with the challenges of Europe, is inflation is there, maybe inflation comes down, but was the ECB really under pressure because they consider they may not have the growth rate to sustain their house of cards in debt?
Well, I think there's two things to keep in mind, at least in the short term. We kind of look at even the ECB's own estimates of what the impact on Eurozone growth is likely to be if oil prices stay anywhere near where they are for a sustained period of time. We had estimates 0.3, 0.4 percentage points lower for GDP. And that's for a 10% increase in oil prices. And we've had a 50% increase in oil prices over the last few weeks. So that's certainly the bad news. Not so much the good news, but at least mitigating the bad news is the fact that coming out of the pandemic, we have to remember that growth expectations, more or less globally, are quite high for this year and still quite solid for next year. So if you get somewhat lower growth because of this increase in oil prices, it really should be absorbable in a way that it wasn't necessarily, if you go back to 2010, 2011, when you had a commensurate increase in oil prices leading into the Eurozone debt crisis, and you did end up with some recession. So we are in a very different place just at the starting point because growth already is quite strong, so we have a bit of room.
Dan, have you rethought anything about your thesis for the rest of the year, considering not only the shock that we're seeing on a humanitarian and a commodity and markets level, but also in this dramatic shift of the central bank reaction function?
In terms of fixed income, really you don't change all that much. I mean, we appreciate we've had this rally in real yields over the last couple of weeks, but nonetheless, I would imagine most people do anticipate once we're past the crisis, hopefully soon, and hopefully peacefully, that real yields will start going back up again. We can endlessly debate what the terminal rate is going to be, but it's got to be higher than where we are. And in addition, we're going to be expecting higher inflation than we had before. So all that argues for higher nominal yields. So that was the view before. That's the view now. I think on equities, again, fundamentally, we do still have growth. There's going to be some damage to corporate profits without question because of what's happening with energy prices. And you're concerned about consumer demand and the hit that we're going to see to pocketbooks. And so you do maybe change a bit your sector allocations. And I think inevitably you had to think about your regional allocations. But I guess it is perhaps a bit surprising how little necessarily changes as far as your allocations compared to what you might have thought under the circumstances.
Dan Morris of BNP. Thank you, sir. Just looking at the price action, Italian two-year yield still up by 16 basis points near session highs. The move on the euro fades, almost unchanged on the session now at 110.82. Two stories here. A quicker wind down of the asset purchase program. The third quarter, some people were looking for that. We seem to have that from the ECB. The second issue, dropping the pledge to end purchases shortly before the rate hike. For a lot of people, including myself, the initial read of that, just dropping that line, would mean that they would have an earlier interest rate hike. I'm not so sure that's the case. I think we've got to wait, Tom, for the news conference with President Lagarde in about 20 minutes.
Strongly agree with that. It's going to be fascinating what she says. John, unfortunately, we have headlines from Ukraine. This is their chief presidential economic advisor. Is it heartbreaking? I think we've already had our hearts broken. We need weapons, ammunition to push back Russia. I would say in the Twitter sphere, John, there's talk of fierce tank battles that are going on. We do not have those confirmed at Bloomberg at this time.
And the next line, we need a complete embargo of energy purchases from Russia. That line, of course, Tom, for Europe.
And for Germany and maybe for the Bundesbank, who you really want to believe had a handle on what we will hear from Christine Lagarde at 8:30.
20 minutes away from CPI in America. The number we're looking for, something close to 8%, 7.9%, the median estimate. Yields are heading north, up 2 basis points on 10s to 197. Equities are heading south, down a little more than 1%. And crude back at 112, up more than 3% today. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The latest attempt at diplomacy in the war in Ukraine appears to have gone nowhere. The foreign ministers of the two countries met in Turkey, their first discussion since the war began. Ukraine's foreign minister says Russia indicated it would continue attacks until its demands are met, and one of those demands is surrender. The UK has added 7 more prominent Russians to its sanctions list, including the owner of Chelsea Football Club, Roman Abramovich. They face a full asset freeze and a travel ban, plus they are prohibited from doing business with UK citizens or businesses. The move effectively derails Abramovich's plan to sell Chelsea. And the U.S. House has passed a spending bill that funds the U.S. government and provides $13.6 billion to respond to the war in Ukraine. The money will help pay for weapons and aid to refugees. Lawmakers from both parties expect more funding will eventually be needed. And Deutsche Bank is promising to raise profitability and has earmarked $8.8 billion in potential capital distributions. CEO Christian Sewing is trying to attract shareholders after his turnaround of Germany's largest lender. The bank's CFO says the immediate fallout of the war in Ukraine has been contained, but it's harder to predict the impact of the aftershocks.
From a market risk perspective, we were defensively positioned and have managed, I think, quite well through these early days. As you say, the second and third order impacts of this crisis are harder to judge.
Von Moltke spoke with Bloomberg's Guy Johnson in Frankfurt. General Electric reaffirmed its financial goals for this year despite volatile markets. GE says profit margins will expand. Adjusted earnings will be in a range outlined in January. CEO Larry Culp is preparing to split up GE into 3 independent companies early next year. Global news 24 hours a day, on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
If you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? combustion engines get electrified.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
We tried to do the sanctions where the oil and gas flows would be less affected so that it impacts Russia and not the United States. Clearly, there's concerns in the market when we now have roughly 3 million barrels that are offline, as most traders don't even want to touch Russian content, and that has driven the prices high.
Amos Hochstein there, the Senior Energy Security Advisor at the U.S. State Department from New York City this morning. Good morning. We are 12 minutes away from CPI in America. The ECB rate decision behind us, in front of us, a news conference with President Lagarde. Futures down 1.2% on the S&P. Yields higher by a couple of basis points to 197.24. No diplomatic breakthrough in talks between the Ukrainian foreign minister and the Russian foreign minister. For the ECB, an earlier wind down of the asset purchase program now expected in Q3. Italian yields higher by 22 basis points, close to 190. Maybe a little bit more flexibility on the path for interest rates in our future. The euro initially spiked, euro dollar through 111, now negative again on the session, 110.74.
And John, I'd note gold up $24, $212, now $2,012, not back to the angst of a couple days ago, but a churning tape right now. Here's what we're going to do. We're going to launch into a discussion of U.S. inflation because it matters to our listeners, our viewers in America, and we will keep our eyes on the headlines of Ukraine, Russia, and all of continental Europe. Michael Gapin joins, Chief U.S. Economist at Barclays, and of course his tour of duty at the International Monetary Fund is noted. Michael, I want to talk about the second derivative of inflation, the rate of change of the rate of change that we're all living. It's personified by my favorite indicator. The Cleveland median is out 2.8 standard deviations. It's on the edge of we've never seen this. What kind of report will we never see in 12 minutes?
Well, what could be a really interesting part of this report is we all expect the headline to be driven by energy, gas, food prices, everything that we've been discussing and you've been discussing on your show in recent weeks. What we will be looking for underneath that is any indication that actually goods prices are starting to roll over. There are signs used car prices could be falling in the next months ahead, and even new car prices this month we think might be falling. So we could see a bit of a dichotomy here. The anticipated decline in goods prices that we've all been waiting for perhaps might show up a teeny bit in this report, but would be completely overwhelmed by, of course, what we would be seeing at the headline level from energy and gas.
Whether it's Dallas trimmed or Cleveland median, let's go inside those trims. What inside the report will give you the best indication of America's inflation?
So the underlying trend, we still think the long run will be driven by the services component, so shelter, rent, owner's equivalent rent, as we have been discussing for some time, a lot of upward pressure there as well. So underlying inflation over the long run in the U.S. is about services. It's less about energy. It's less about goods. So that if you can strip things away and think of, well, inflation should be moving lower over time, where might it settle in? Then you'd want to focus on services.
The former New York Fed President Bill Dudley came on this program, Mike, a number of weeks ago. In fact, it was a few months ago, and he said the Fed forecasts were in fantasy land. This is the forecast for growth in 22. 4%, for core PCE, 2.7%. Is that fantasy land?
Well, the Fed's forecasts always assume policy works and you get an optimal outcome, which in this case is a soft landing. Yeah, I've been thinking their growth forecasts to me have been too optimistic. When they were at 4, we were at 2.9, and now we're at 2.6. I think you mentioned you were on with my good friend Seth Carpenter a few segments ago. They've been revising their growth lower in the U.S. They're down 40 basis points, he said. So that 4% number has to come down a lot for a variety of reasons. And yes, they've got to bring that inflation number higher just because of where spot inflation is. I still think the outlook will be a Goldilocks soft landing forecast. The Fed has to kind of forecast that. But yes, I think some reckoning here in the data will mean big changes in their outlook.
Mike, I want to sit on that point that you made. This assumes that their policy recalibrations will work. Do you think that that is in question?
Yes, I do. And it's not necessarily a direct criticism of the Fed. I would just say that, you know, the Fed, as you all know, focuses on things like core and trim means. And it's a recognition that there are some prices that are set in markets that are largely beyond their control. And we've been getting movements in those prices recently, and we're all constantly revising our forecasts higher and saying, oh yes, the peak is coming, it's this month, it's getting pushed out. So yes, I think the ability for central banks to control inflation in this environment without generating a substantial contraction in demand is certainly at question.
And Mike, you talked about they're assuming, and they kind of have to, this Goldilocks soft landing kind of outlook. From your perspective, given the speed that we have seen of the increase in CPI and the increase in some of these inflationary inputs, do you think that a soft landing is possible at all?
I do think it's possible, and I would still say it's probable, but I think the odds of that come down. And in terms of, you mentioned the speed of the move in inflation, or sorry, in the move of prices, and in this case, energy. That is important. Some of the work that we've done suggests it is more about the speed of the move in oil prices than the level. And what tends to happen in cases where gasoline prices shoot higher in a very short period of time, consumers don't know what to do, so they pause. And what they do is they stop buying durables. So durables is the most sensitive part of consumer spending to changes in oil prices. And if you look at history, it'll say when the 3-month annualized change in CPI exceeds 9%, we tend to get major pullbacks in durable spending. That happened, for example, in the 1990 Gulf War, obviously echoes of that in the current situation and following Hurricane Katrina. So major disruptions to oil, a sharp rise in energy prices, consumers tend to pull back discreetly on durables purchases.
Mike, we get lucky this morning. You're going to stick with us. Mike Gapin there of Barclays, sticking with us into CPI in about 5 minutes' time. The estimate 7.9%. Michael Gapin is at 7.9%. JP Morgan at 8%. Morgan Stanley at 8%. The median forecast, Tom, 7.9%. Before we run away and focus on CPI and an ECB news conference, moments ago, from a member of the EU Commission, Tom, Mariupol is under siege. This was out on Twitter. Russia's shelling of the maternity hospital is a heinous war crime. That's come from the EU Commission, Tom, just moments ago.
Important that it comes from that institution, but I'm going to suggest, John, that is news 12 hours old, and you wonder what will be the new grimness of this day. We're 7 hours away. We're 3 p.m.-ish in Ukraine, and I really wonder where the news is going. John, an important note from Ben Emmons at Medley, and he is heated that this ECB is an important note, and he says it's a signal to the Fed that they've got to stop with a market-friendly tone and confront the moment.
We are moments away from CPI in America. The estimate is 7.9%. After that, shortly thereafter, we'll hear from the ECB President Christine Lagarde. Going into that, Italian 10-year yields higher by 21 basis points. The euro now unchanged at 110.79. Crude up more than 4% at 113.25. A really interesting, important moment for global markets. Coming up next on Bloomberg.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently. because various studies showing that reduction up to 40-fold, meaning that a third dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus Omicron variant still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Inflation in America, the data, the moments away, seconds away, with futures negative 1% on the S&P, on the NASDAQ, down by 1.4%. It yields higher at the front end by 4 basis points to 172 on a 2-year yield, the highs of the year, going into inflation in America. There's the print. Here's Mike McKee.
Well, John, economists are spot on with their forecasts. Inflation rises 0.8 on a headline basis during the month of February, and that puts it at 7.9% on an annual basis, which is exactly what was forecast, 0.4 higher. It is the highest since January of 1982. What happened then? Steve Innocenzo set a record for the fastest hat trick in hockey history, Tom. That is my size and scope for you. The core rate goes up on the month by 0.5%, exactly as forecast, which puts us at 6.4% for year over year. So in a sense, economists have this right. And the problem is, of course, this is all February data, and the war in Ukraine did not start until February 24th. So it doesn't encompass most of that. Taking a look at some of the biggest movers in the index, gasoline is what we wanted to check, because that was what really made a difference the last time. And it, I don't have that one right in front of me yet. This is not coming up as the right number, so hold on just half a second. Here we go. The gasoline price index goes up by, actually goes up by, 6.6% after an 0.8 drop. So gasoline, a major contributor to this, and that was before the war. Food prices up by 1%. That's also a major increase, and those are the two categories that Americans pay the most attention to. Used cars is something that everybody watches, and it looks like used cars at this point down 0.2%. I'm not sure that is the first time in some time, it's certainly the first time in the data I have in front of me that we've seen used cars drop. So maybe some of the temporary things that people have been talking about are starting to come through. But on the other side, we have the big push in the headline. One other thing I want to mention, because Michael Gapin brought it up, services up 0.5%. So that does suggest that we are seeing some service price pressure as the COVID lockdowns start to end.
Mike, just going to dig through the data. Look at the price action on twos. We fade a bit from session highs back south of 170 at about 169, up a couple of basis points on the session now. In line, but Tom, in line at 7.9%. And given the contribution we expect from gas prices for this month, the month of March, and the month after that, this one's not set to fade quickly anytime soon.
You know, again, this is a Fed that's data dependent. They're going to need more data off of this. I mean, John, it is not a time for jokes, but to frame it as Mike McKee it did here, this is an inflation report back to Let's Get Physical by Olivia Newton-John, or I believe that's the one who did the song a few years ago. John, this is seriously, this is a generational report, and it will have a generational impact.
Yeah, ECB President Christine Lagarde just walked into the room for her opening statement. Before we turn to her for her forecasts and the Q&A session at the ECB, Mike Gapin, we have to come to you, sir, from Barclays. You've had a bit of time to pour through this one. Your takeaway?
Well, it's probably the first time that we've talked in 2 years where we got a forecast spot on. So, you know, I guess we're happy about that. But look, I think your main point was, look, this is a report that came in before the recent conflict. So the contours were as we had expected. We were looking for gas to be up 7%, so very much in line with what Michael had reported there. Food prices up strongly, right? This is where the new impulse is coming from. So for the moment, we've got a little reprieve from goods prices. Let's see if that continues. If it does, it'll provide some offset from headline inflation, but inflation's not likely to roll over and begin to come down for several more months here. So I think this kind of sets the stage for where we are now, and we need to see how long this conflict plays out and how disruptive the sanctions regime actually is.
Michael Gapin, honestly, the reaction in markets is not that significant. People were prepared for this because you and others got it spot on. How much does that tell you about how much or how little people are pricing in 7.9%, given where yields are?
Yeah, I mean, it's a difficult situation to be a bond trader at the moment. So I think where yields are is consistent with, again, medium-term expectations that this is going to that inflation will come down and be back at levels that we're more comfortable with. That's obviously a bet that the market is making. And one of the reasons they're doing that is because of what the ECB said this morning and the reaction in bond yields in Europe, what the Fed has been saying. Right. It's like, yes, inflation is high, but we will do what we need to do to bring that down. And that's why long end yields are where they are.
Michael Gapin, I have hinged on this report for, I'm going to say 4, if not 6 weeks. How does this change the question you would give Chairman Powell on March 16th?
I think the question I would give him is beyond this. I think the question I would give him is about how do you conduct monetary policy in an environment where the inflation that you're getting is largely beyond your control and uncertainty has been rising, right? And I think the answer to that is, you know, tread carefully, move. I think sitting on the sideline isn't an option. I think they have to move. But when you're in an environment when you don't know exactly what your policy move is going to bring in terms of a response from markets, you have to go cautiously.
Mike Gapin of Barclays, before we head over to the news conference over at the ECB, this is what you've missed so far, just the forecast pouring out. So let me go through them for you. GDP for 2022, 3.7% versus 4.2%. Wow. So the GDP forecast for 22 gets a cut, 23 gets a cut, 24 is in line at 1.6%. Inflation of 5.1% for 2022 versus the previous estimate of 3.2. 2023 lifted to 2.1 versus 1.8. So that is a lift to the inflation outlook, a cut to the GDP outlook. Let's head over to Frankfurt, Germany, and listen in to President Lagarde right now.
Increasingly likely that inflation will stabilize at its 2% target over the medium term. In alternative scenarios for the economic and financial impact of the war, which will be published together with the staff projections on our website, economic activity could be dampened significantly by a steeper rise in energy and commodity prices and a more severe drag on trade and sentiment. Inflation could be considerably higher in the near term. However, in all scenarios, inflation is still expected to decrease progressively and settle at levels around our 2% inflation target in 2024. Based on our updated assessment and taking into account the uncertain environment, the Governing Council today revised the purchase schedule for its asset purchase program for the coming months. Monthly net purchases under the APP will amount to 40 billion in April, 30 billion in May, and 20 billion in June. The calibration of net purchases for the third quarter will be data dependent and reflect our evolving assessment of the outlook. If the incoming data support the expectation that the medium-term inflation outlook will not weaken even after the end of our net asset purchases, the Governing Council will conclude net purchases under the APP in the third quarter. If the medium-term inflation outlook changes, and if financing conditions become inconsistent with further progress towards our 2% target, we stand ready to revise our schedule for net asset purchases in terms of size and/or duration. Any adjustments to the key ECB interest rates will take place sometime after the end of our net purchases under the APP and will be gradual. The path for the key ECB interest rates will continue to be determined by the Governing Council's forward guidance and by its strategic commitment to stabilize inflation at 2% over the medium term. Accordingly, the Governing Council expects the key ECB rates to remain at their present level until it sees inflation reaching 2%, well ahead of the end of its projection horizon and durably for the rest of the projection horizon, and it judges that realized progress in underlying inflation is sufficiently advanced to be consistent with inflation stabilizing at 2% over the medium term. We also confirmed our other policy measures as detailed in the press release published today at 1:45. I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. The economy grew by 5.3% in 21, with GDP returning to its pre-pandemic level at the end of 21. However, growth slowed to 0.3% in the final quarter of 21 and is expected to remain weak during the first quarter of 22. The prospects for the economy will depend on the course of the Russia-Ukraine war and on the impact of economic and financial sanctions and other measures. At the same time, other headwinds to growth are now waning. In the baseline of the staff projections, the euro area economy should still grow robustly in 22, but the pace will be slower than was expected before the outbreak of the war. Measures to contain the spread of the Omicron coronavirus variant have had a milder impact than during previous waves and are now being lifted. The supply disruptions caused by the pandemic also show some signs of easing. The impact of the massive energy price shock on people and businesses may be partly cushioned by drawing on savings accumulated during the pandemic and by compensatory fiscal measures. Over the medium term, according to the baseline of the staff projections, growth will be driven by robust domestic demand, supported by a stronger labour market. With more people in jobs, households should earn higher incomes and spend more. The global recovery and the ongoing fiscal and monetary policy support are also contributing to this growth outlook. Fiscal and monetary support remains critical, especially in this difficult geopolitical situation. Inflation increased to 5.8% in February from 5.1% in January. We expect it to rise further in the near term. Energy prices, which surged by 31.7% in February, continue to be the main reason for this high rate of inflation and are also pushing up prices across many other sectors. Food prices have also increased owing to seasonal factors, elevated transportation costs, and the higher price of fertilizers. Energy costs have risen further in recent weeks, and there will be further pressure on some food and commodity prices owing to the war in Ukraine. Price rises have become more widespread. Most measures of underlying inflation have risen over recent months to levels above 2%. However, it is uncertain how persistent the rise in these indicators will be, given the role of temporary pandemic-related factors and the indirect effects of higher energy prices. Market-based indicators suggest that energy prices will stay high for longer than previously expected, but will moderate over the course of the projection horizon. Price pressures stemming from global supply bottlenecks should also subside. Labour market conditions have continued to improve, with unemployment falling to 6.8% in January. Even though labour shortages are affecting more and more sectors, wage growth remains muted overall. Over time, the return of the economy to full capacity should support somewhat faster growth in wages. Various measures of longer-term inflation expectations derived from financial markets and from surveys stand at around 2%. These factors will also contribute further to underlying inflation and will help headline inflation to settle durably at our 2% target. The risks to the economic outlook have increased substantially with the Russian invasion of Ukraine and are tilted to the downside. While risks relating to the pandemic have declined, the war in Ukraine may have a stronger effect on economic sentiment and could worsen supply-side constraints again. Persistently high energy costs, together with the loss of confidence, could drag down demand more than expected and constrain consumption and investment. The same factors are risks to the outlook for inflation, which are on the upside in the near term. The war in Ukraine is a substantial upside risk, especially to energy prices. If price pressures feed through into higher than anticipated wage rises, or if there are adverse, persistent supply-side implications, inflation could also turn out to be higher over the medium term. However, if demand were to weaken over the medium term, this could also lower pressures on prices. The Russian invasion of Ukraine has caused substantial volatility in financial markets. Following the outbreak of the war, risk-free market interest rates have partially reversed. The increase observed since our February meeting and equity prices have fallen. The financial sanctions against Russia, including the exclusion of some Russian banks from SWIFT, have so far not caused severe strains in money markets or liquidity shortages in the euro area banking system. Bank balance sheets remain healthy overall, owing to robust capital positions and fewer non-performing loans. Banks are now as profitable as they were before the pandemic. Bank lending rates for firms have increased somewhat, while lending rates for household mortgages remain steady at historically low levels. Lending flows to firms have declined after increasing strongly in the last quarter of 21. Lending to households is holding up, especially for house purchases. So summing up, the Russian invasion of Ukraine will negatively affect the euro area economy and has significantly increased uncertainty. If the baseline of the staff projections materializes, the economy should continue to rebound thanks to the declining impact of the pandemic and the prospect of solid domestic demand and strong labor markets. Fiscal measures, including at the European Union level, would also help to shield the economy. Based on our updated assessment of the inflation outlook and taking into account the uncertain environment, we revised our schedule for net asset purchases over the coming months and confirmed all our other policy measures. We are very attentive to the prevailing uncertainties. The calibration of our policies will remain data-dependent and reflect our evolving assessment of the outlook. We stand ready to adjust all of our instruments to ensure that inflation stabilizes at our 2% target over the medium term. And we are now ready to take your questions.
Thank you, President Lagarde. And today the first question goes to Caroline Look of Bloomberg News. Caroline, please.
Hi, good afternoon, President Lagarde, and thanks for taking my question. My first one is, a lot of the recent communication from the ECB has been about how supply-driven the current inflation and even core inflation surge is. So how much agreement was there in the Governing Council about accelerating the pace of normalization now? And secondly, your new guidance states that interest rates will follow some time after net bond buying ends. So does that mean that we are back to excluding rate hikes later this year, or how does that square with the significantly higher inflation projections you just presented?
Thank you very much for your three questions. First of all, in terms of Governing Council, we had very intense discussions about the current economic situation, about the outlook, about the uncertainty. And as with most institutions, communities, families, and probably you all, the war of Russia against Ukraine has tainted and overshadowed a lot of those discussions. There were different views around the table in all directions. But after those good discussions, there was a determination by all Governing Council members to rally the proposal that was put together by the Executive Board and presented by our Chief Economist. But after those good discussions, there was a determination by all Governing Council members to rally the proposal that was put together by the executive board and presented by our chief economist. It takes a balanced approach. It delivers on the mandate that we have, which, as you know, is price stability in the face of what we are seeing. So your second question related to accelerating normalization. That was not the decision that was made today. The decision that was made was to progress step by step, to acknowledge the added uncertainty that we are facing, and to therefore have added optionalities so that we can, in all circumstances, respond in an agile way. You will have noted that our decision in relation to asset purchases under the APP is conditional and clearly states that we have a declining pace of purchase for Q2, and that for Q3, if the outlook for medium-term inflation is confirmed by the data, we will indeed end asset purchases. But if, on the other hand, the data, which are critically important because we are data dependent in our decisions, do not support this medium-term outlook as we see it now, then we indicate very clearly in the monetary policy statement that I have just read that the Governing Council stands ready to revise, both in terms of timeline and in terms of volume, its purchases. So it is a conditional provision that you see in our decision. And we are not in any way accelerating. This was in line with our December meeting, with our February meeting and press conference. And what we are doing is confirming our step-by-step approach, our maximum optionalities in the face of maximum uncertainty, but also delivering on our mandate, which is price stability. The medium-term inflation outlook, both in the baseline delivered by staff and in the scenarios that you will see tomorrow in details, which are all, of course, a worsening of the situation. There is not a positive and a negative, they're both more negative. But in all those baseline and two scenarios, the medium-term inflation outlook arrives roughly at target. I think in terms of optionalities, I'll be happy to expand a little bit because this is clearly what has guided us. Added uncertainty, added optionalities. So what are we doing? We are clearly identifying the pace. We are procuring a situation where we can decide sometime after net asset purchases what decision we should make in relation to rates. In terms of timeline, we're also saying that we will end net asset purchases under those data that I have just described in the course of Q3. Q3 is 3 months. So we tried to have as much optionality in order to deal with the situation. I have underlined in my response to you sometime after, which is a substitute to shortly before. And obviously, sometime after is an open time horizon, which will be data dependent, the occurrence of which will be data dependent. I think that was your third question. Sometime, I think I have explained it with this response. I hope so.
Thank you, President Lagarde. And the next question is for Annette Weisbach of CNBC. Annette, please.
Thank you very much for taking my question, President Lagarde. I would like to ask you a question because on the surprise factor you actually introduced today, because most of your watchers were completely convinced that you're going to pause and not change anything because of that heightened uncertainty. So perhaps you could elaborate a little bit on the thinking in the Governing Council on that issue to now reduce the pace of the APP, and why didn't you wait another month? And then I'd like to go back as well to the rate question. Of course, sometime after could mean anything, but I would like to bring you back to that question whether you see a rate hike if things develop according to your dominant scenario now in the course of this year. Thank you very much.
Thank you for your question, but I will have difficulty addressing your second question because I don't know what is my dominant scenario. We have a baseline and we have two scenarios. One is adverse, one is severe, and you will have all the details of those scenarios tomorrow. Suffice to say that watchers are not those who make Governing Council decisions. It is the Governing Council, 25 sensible people around the table who look at what their mandate is, what the projections deliver, what the medium-term outlook for inflation looks like, what the risks are, what the uncertainty is, and on the basis of all that, who are trying to deliver a predictable course while being very cautious. So that's really what we did. And, doing what you have to do should be the predictable thing. Adding uncertainty to an uncertain situation would not have been the right answer. Now, you coming back to this sometime after. We came from a shortly before, because it addressed actually one end of the spectrum relative to the others. In other words, the time it takes to purchase assets relative to the time when interest rates could be hiked. And it did say shortly before, so there was an assumption that there would not be such a long period of time between net asset purchases would stop and there would be a rate hike. And it was decided, and we debated that indeed, to replace it with sometime after. And that respects the sequencing that we had, which is net asset purchases, and subsequently, the Governing Council looks at all the data to determine whether it is time to hike rate or not. And clearly, sometime after is all-encompassing. It can be the week after, but it can be months later. And by that, I think we want to indicate that the time horizon is not what is going to matter most. It's the data that will support the decision that is made by the Governing Council to assess medium-term inflation outlook and whether a rate hike is warranted. You will have noted, by the way, that we have removed the bias that we had by eliminating lower in relation to our interest rates. Thank you.
Thank you, Madame Lagarde. The next question is for Francesco Canepa of Reuters. Francesco, please. Francesco, can you hear us? We cannot hear you. We will then go to someone else and I'll come back to you. So in the meantime, Isabella Bufacchi of Il Sole 24 Ore, please. Isabella.
Good afternoon, and thank you for taking my questions. I apologize for the video that is not on. President Lagarde, I have a first question on your financial stability toolbox. How far is the Governing Council worried about financial stability in the euro area? You made a reference to the no liquidity shortages, but you did announce the liquidity lines. So maybe you can tell us what you can do if for the financial stability. And then a second question is actually on digital currencies. I know you made so many decisions today, but EU sanctions targeted the Central Bank of Russia in an unprecedented way, and this triggered a new focus on central bank digital currencies. Can we expect that the ECB is going to accelerate the process for the digital euro? Thank you.
Thank you, President. I will try to answer your question on financial stability. Well, it's quite clear that we have seen since the beginning of the invasion, volatility, tensions, stress in financial markets. But I think that perhaps, the main point that I would like to stress is that this situation is not comparable to the one that we had 2 years ago. Liquidity has not disappeared from the markets. And despite, the situation of tensions that we have seen in certain financial and capital markets, well, liquidity, as I have said before, has not disappeared. We are closely monitoring the different financial markets. We have seen a lot of volatility, for instance, in equity markets. As well, we are also looking at what's happening with corporate bonds. In terms of corporate bonds, spreads have widened, but as I said before, liquidity has not faded out. And finally, there is a very specific market that we are looking very carefully. That is the derivative market. And mainly, one part of this derivative market is the commodity derivative market. So far, in the clearing houses, we have not seen any sort of a special volatility there. All the margin calls derived from the increase in commodity prices have been honored. But we are closely monitoring the situation. And finally, in the government bond market as well, we have seen ups and downs in terms of nominal yields, but the spreads have been quite contained. So the conclusion is Russia is important in terms of energy markets, in terms of commodity prices, but in terms of the exposure of the financial sector, of the European financial sector to Russia, is not very relevant. And simultaneously, the size of the Russian economy is quite limited. It's only 2% roughly of the world economy. So the situation, perhaps the main conclusion, is that the strains and the tensions that we have seen are not comparable at all to what it happened at the beginning of the pandemic.
Yeah. And on your question concerning CBDC, you know my views on CBDCs, and you know that I have pushed that project. Fabio Panetta is working hard on that together with members in the entire Euro system, with a high-level task force that is working really hard on moving forward. But in a way, I'm really pleased that attention is now focused on the role that cryptos can play and the role that central bank digital currency can have when they are implemented. We have a schedule, as you know. The Governing Council decided back in October 21 to launch a 2-year investigation phase, and it is at the end of that investigation phase that the decision will definitely be made to launch the CBDC and to make it a reality. We can't go wrong with that project. I'm confident that we will move ahead, but that's going to be a decision of the Governing Council. I think it's an imperative to respond to what the Europeans expect, and I think we have to be a little bit ahead of the curve if we can on that front. So if we can accelerate the work, I hope we can accelerate the work. I will certainly support that. And I was delighted to see that in the United States, there was an executive order by President Biden to actually expect similar effort and focus and progress on CBDCs, cryptos. And I think that it will take all the goodwill of those who want to support sovereignty, who want to make sure that monetary policy can be transmitted properly using our currency will endeavor. On the issue of financial stability, I totally concur with my Vice President, De Guindos, but I will also point you to the last sentence in the first paragraph of our monetary policy statement. And I know that there's been an abuse of that, but we mean it. We will take whatever action is needed to fulfill the ECB's mandate to pursue price stability and to safeguard financial stability. So, have no doubt.
Thank you, President, Vice President. Francesco, we want to give it another try, so please ask your question. Some transmission problem today. So then I would give the next question to Klaus-Rainer Jakisch of ARD Television. Klaus-Rainer, please, for you. Klaus-Rainer, we cannot hear. I see you talking, but we cannot hear you. Until the problem is sorted out, I will then give the question to Martin Arnold of Financial Times. Martin, I hope we can hear you.
Hello, President Lagarde. Can you hear me?
Yes, indeed.
Excellent. My two questions are as follows. Firstly, with the ECB now accelerating the withdrawal of its monetary policy stimulus, do you think the onus must be on fiscal policy to support the Eurozone economy from the impact of the shock from the Russian invasion of Ukraine? And the second question is, what would the ECB's reaction be if the Ukraine Central Bank was to request a swap line from the ECB? Thank you very much.
Well, thank you for your question. I'll start with the second one. We are actually exploring, together with other European authorities, and in particular with the Commission, how we can deploy tools in order to support the Ukrainian people and the Ukrainian authorities. So clearly looking at how support can be structured, whether under existing product, you mentioned swap line, repo line, or under other products, because clearly we have conditions under which we can extend swap lines and repo lines. And if those conditions are not satisfied, we need to find alternative ways of providing support. And that is what we're doing, both in relation to the authorities, but also in relation to the people of Ukraine, who, when they become refugees, unfortunately, pass the border, need to access alternative currencies to theirs, which, as a result of the decision that was made, is not convertible as it used to be. So we are really working hard. I hope that in the next few days we'll be able to provide tools and means to extend support to both the people and to the authorities, together with the Commission and sometimes, in some cases, national authorities within the Euro system. On your other point, let me just make that clear once again. The decisions that we are making today are the logical continuation of our December decisions, of our February communication, and we are on this path, which is data determined and which is also delivering on our mandate, which is that of price stability. So we're not talking about accelerating, we're not talking about tightening, we're talking about normalizing, simply because we acknowledge the fact that in the present environment, which is that of high inflation and not low inflation, as it was in the past, the support that net asset purchases can give to policy rates is getting close to conclusion, and therefore requires that we decelerate the pace of purchases, consider the fact in Q3, or at the end of Q2 rather, to decide whether, depending on the data that we get, we effectively conclude net asset purchases, the principle of which was agreed today. Thank you.
Thank you, Madame Lagarde. I see that now Balazs Korani from Reuters is connected, so perhaps you can connect Balazs for you, please.
I'm trying my best. Do you hear me?
Yes.
Great. Apologies for this technical issue. President Lagarde, in your press conference, you mentioned that in the discussion there were various options being discussed, or at least advocated by governing council members. Could you tell us a bit more? Were there people who suggested no end date, or what were the options that governing council members advocated? The other question I have is sort of this longer, broader question about inflation. I think it's clear that even after the war, there's no returning to the pre-war normal. Governments are spending more on defense, commodity prices are likely to stay higher than before, and the green transition is going to be accelerated. Now, all of these factors are long-term inflationary, I believe. Is this something that you discussed in the Governing Council, and how were these factors taken into account in your projections?
On your first question, I'm sure that some of you will really enjoy picking up the phone and trying to question who said what, when, and on one topic. Let me just be very clear on that. There were some members who thought that given the uncertainty that we have, we should be uncertain as well and do nothing. There were other members who thought that despite the uncertainty, we should move ahead and not have any conditionalities. Okay, so you have both ends of the spectrum. And I think that the proposal that was debated and supported by the executive board and presented by Philip Lane, the chief economist, was this balanced approach of taking into account the baseline produced by staff, acknowledging the inflation numbers that we are seeing now and the inflation outlook that we have for the medium term, to propose a path that reduces net asset purchases, brings us to concluding the net asset purchases under the conditions that data actually confirm the outlook that we are seeing now and that we are seeing in the scenarios produced by staff. So that's what the package was, and it is a package. It's a package of a determination, conditionalities, the removal of the shortly before, which has not been replaced by shortly after, but by sometimes after, so as to delink, and maximum agility and flexibility, as you will have seen in the description of the various instruments, and that thing that was published in the press release. And I'm here referring clearly to flexibility that we give ourselves under the PEP reinvestment policy. Speaking of reinvestment, let's not forget that we have a I just want to, maybe I'll have the right exact number that I can give you in terms of reinvestment policy under the APP. I thought I had that somewhere. Anyhow, we have more than 5 trillion euros worth of assets that we will be reinvesting over the course of time. So it's not as if we were, tightening monetary policy going forward. We are normalizing monetary policy with the caveats that I have just outlined. Now, obviously, when we look at the medium-term inflation outlook, we also do a risk analysis. And while we are clearly of the view that given the drivers behind inflation, energy predominantly for the moment, supply bottlenecks, food prices increases, and a broader increase of prices in general, which is coming from energy predominantly and translates throughout all the items, clearly risks to inflation is to the upside, particularly in the short term, but possibly also in the medium term, but not exclusively, because risk to inflation could also be to the downside. So you mentioned some of the investment projects, some of the fiscal spending that will probably take place over the course of the next few years, and that will certainly continue to push prices up. If anything, it's a good reason that we should stick to our mandate of price stability and of bringing medium-term inflation outlook to our target of 2%. Thank you.
Thank you, Madame Lagarde. And the next question goes to Mark Schreers of Börsenzeitung. Mark, please. You are muted, Mark, still. We can't hear you. No. No, sorry. I will then go to Eric Albert of Le Monde. Eric, please.
Good afternoon. I hope you can hear me.
Yes.
Thank you very much for taking my question. I got a couple of questions. One on the fiscal side. As we are talking now, the EU leaders meet in Versailles. How much can you expand a bit on what you expect from the fiscal side, especially from the EU side? Would you like to see some common borrowing again? And on the inflation, mostly on the energy shock, before the war, there was already a pretty big energy shock, but some hope that maybe it was stabilizing. There's absolutely no hope now that it will stabilize in the short term. How long-lasting do you believe this energy shock might be? It looks like, if Europe turns its back to Russian gas and oil, there will be a very long-lasting shock, and it will be for the foreseeable future. What do you say to that?
Well, thank you for your two questions. On the first one, which relates to the fiscal effort, we clearly point out in the monetary policy statement that fiscal support will continue to be critically important. What form it takes, whether it is a national fiscal effort with a good focus, with target on those that are most affected by the current crisis, particularly energy crisis, or whether it takes a European-wide format, is something that obviously the leaders will have to decide, and I'm sure that they are, as we speak or as they meet, be addressing those questions. I think we have a long-standing record of arguing for some fiscal facility at the European-wide level in order to respond to shocks. We are clearly facing a major shock, whether it is just the pure war or whether it is the energy prices. But this fiscal facility that we've advocated, we stand by and do believe that it can be extremely helpful, particularly in order to move Europe to a more integrated basis. On the, when will energy prices stabilize? In our assumption and in the scenarios that have been developed, there is the assumption that oil and gas and energy prices in general will, throughout the projection exercise, stabilize. Certainly not in the short term. What we are not seeing, and that takes me a little bit away from energy prices, but it's clearly related to how long it takes to stabilize. But what we're not seeing so far, and we are very, very much scrutinizing the numbers, is wage pressure. When we look at the numbers for the fourth quarter of 21, the wage increases have actually been lower than the average of 2020. So we are trying to get as much intelligence and as much understanding of how and where wage pressures are going to come from, because it will have an impact on the underlying inflation that is integrated in our medium-term outlook and in our forward guidance. Thank you.
Thank you, President Lagarde. And the next question is for Eshi Nelson of the New York Times. Eshi, please.
Hi, can you hear me okay?
Yes.
Okay, fantastic. Thanks, President Lagarde. Just two quick questions. To what extent was the plan the EU put forward to reduce its dependency on Russian energy considered in the current forecast for inflation? And secondly, on your point about a short time after that wording for raising interest rates, are we supposed to read that as a longer wait than how it was described before, where asset purchase program would end shortly before interest rates would increase?
I would have to double check on your first question, because I'm not aware that the plan to reduce dependency on Russian gas was incorporated as a geopolitical decision or as an energy decision made by the European authorities and with the national leaders of the member states. What I know for sure is that we factored in a significant increase of prices wherever that product comes from. On the, sometime after, I know this seems like great elaboration, and in a way it was. We could have substituted the shortly before by shortly after, but that would have made it too time dependent in terms of decision making. We want to be data dependent. So whenever the data confirms that the medium-term inflation outlook is at target, then the decision should be made. We're guided by our strategy review. We are guided by our forward guidance. We're not guided by a time element that would predicate that within X weeks or within X months, decision will be made. So the deliberate use of sometime after opens sufficiently wide an interval of time so that we can review the data, determine the robustness of the data, make sure that some uncertainty has cleared a bit so that we can make a decision. I don't know how I can more explain this sometime after, but that's what our debate was about.
Thank you, President.
And again, if I can just insist on that, we want to have as much optionalities as possible. We recognize that there is huge uncertainty and that things can go in all sorts of directions. And we want to be able to respond to those circumstances. And to do that, we need to have all optionalities on the table. We keep all the options opened, and we will proceed, and we are proceeding step by step.
The next question is for Azahara Sanchez of the Spanish television La Sexta. Azahara, please.
Hi, thank you. Can you hear me?
Yes.
Okay, thank you very much. My question is for Vice President De Guindos. Back in 2012, when you were Spain's economy minister and the Sareb was created, you were in a press conference where the Vice President Soraya Sáenz de Santa María said that Sareb would not cost an euro for the taxpayer, and you yourself said that it would minimize the impact that the bank intervention could have in the cost for the taxpayers. Now Sareb's 35 billion euro in debt is officially public debt. Did you fool Spanish people back then? Thank you very much.
Well, what I have to say is that Sareb was part of the package to rescue the Spanish financial system, and it was agreed with the European Commission, with the ECB, the IMF. And, well, Sareb was perhaps, the most powerful instrument in order to clean up the balance sheets of the Spanish banks. And I think that, is right. It has a debt of 35 billion euros, but as well now, it has assets worth clearly beyond 32 billion euros. So, Sareb, it has been a quite a useful instrument that was used as well. And this instrument was used in other countries like Ireland, for instance. And I think that what we have to do is to try to gain time in order to get advantage of the evolution of the real estate in Spain, that now is much more positive, and to reduce as much as possible the level of debt of Sareb.
Thank you, Vice President. This brings to the end our press conference today. Thank you very much for joining. Our next regular press conference is on 14 April, and up until then, best wishes, stay safe. Thank you, bye-bye.
That wraps up a, let's call it messy, news conference in Frankfurt, Germany with ECB President Christine Lagarde. Here's your price action going into the opening bell in New York City a few minutes away. The equity story shaping up as follows. Equity futures in the United States on the S&P 500 negative by a little more than 1%. The euro negative as well. We've been dancing around over the last couple of hours. We'll talk about that a little bit more a little bit later. Euro dollar negative 0.4% to 110.33. The move in the Italian bond market, Germany too, notable. A big move on the Italian 10-year by 21 basis points. To 190, just short of that level. On the German 10-year, up around about 6 basis points. The words of President Lagarde, there were many through the last 60 minutes or so, maximum optionalities in the face of maximum uncertainty. Take a listen.
It can be the week after, but it can be months later. And by that, I think we want to indicate that the time horizon is not what is going to matter most. It's the data that will support the decision that is made by the Governing Council.
Guy Johnson with us from Frankfurt, Germany. Guy, some of this needs explaining. So in the statement, this is the language that we've used. Any adjustments to the key ECB rates will take place sometime after the end of the Governing Council's net purchase under the APP and will be gradual, etc., etc. Sometime after can be the week later, but it can be months later. Guy, a lot of people watching that are exhausted now. Make sense of it.
I'm really struggling, John. I have to say, Christine Lagarde may not have a PhD in economics, but she's certainly beginning to speak their language. On the one hand, this, on the other hand, that. That certainly seems to be the narrative coming out of here. She used the word optionality time and time and time again. But clearly, you take a look at the price action, you take a look at that statement, the hawks are much more in charge of this narrative. This is a narrative driven by a continuing upside surprise on inflation. Christine Lagarde talked about the idea that they were not accelerating the exit from extraordinary monetary policy, but certainly judging by the market reaction, and you were bringing up the BTPs just a moment ago, that is the way that the market is reading that. It looks like the hawks are definitely in charge. She's trying to maybe just sort of tamp down expectations a little bit, but nevertheless, optionality is definitely going to be the key word here. The ECB is clearly data dependent. It may not be an acceleration, but certainly I would have thought, judging by the data we've seen thus far, the staff projections that we've been getting, that a 2022 hike is now certainly back as being maybe the base case for the ECB, John.
Guy, you'll have to forgive my frustration in my voice, but following all of this has been pretty tiresome. Futures going into the opening bell, ran about down 45 points on the S&P, down about 170 on the NASDAQ. Your euro negative 0.4, we've talked about that, yields up 2 basis points, approaching 2% again at 198. Guy, President Lagarde talked about they weren't in any way accelerating tightening, but you just go through the statement and look at the wind down of QE. The numbers just speak for themselves. Yep. I just wonder what's going on inside the Governing Council. There was this sort of off-the-cuff remark about you're going to go out there and call people. They're going to say different things about different things. Are we expecting that kind of story immediately after a news conference with the ECB and people coming out and saying, this is not what we wanted?
Well, I would be very surprised if we don't get commentary from either fringe, apologise for the ambulance, either fringe of the governing council here. Clearly there were some doves that wanted to be cautious here, but I would say on balance, the hawks are now in charge of the governing council. Lagarde is clearly struggling with that. She clearly doesn't have the same touch that Mr. Draghi once did in controlling the narrative. The narrative is controlling her rather than the other way around, and it is clear that the hawks are in charge. The statement said it, the star projections gave you that indication as well, the market reaction is telling you that as well. This is a central bank that is exiting its extraordinary monetary policy at a faster rate than the market anticipated. The market clearly was wrong-footed going into this, John. We are now starting to correct that very quickly. Inflation is the mandate. Inflation is the problem. That's what they've got to focus on right now. The pace, I think, will be determined ultimately, though, by growth.
The Italian bond market speaks to everything you just said. Guy Johnson, thank you. Joining us now, Bauer Stocks, Emily Hill, Pictet, Luca Paolini. Luca, I want to come to you. Was that a dovish news conference or a hawkish one?
Well, I think the message is pretty clear, right? I think there is a tightening of monetary policy here in Europe. At the same time, Christine Lagarde is trying to send a more dovish signal, but the reality is the market, I think, is pretty clear. There is more tightening. In a way, less easy means tightening. And I think it's also pretty clear that the focus now, the top priority, is to fight inflation and not to support growth. So I think that's pretty clear. Now, if the first hike is going to be in September or October, probably doesn't make a big difference. But I think the message is hawkish, and I think the market is reacting because of that.
Well, that's the challenge. They've had to downgrade the growth outlook, upgrade the inflation forecast. And Emily, I wonder if we're about to see the same thing happen in the United States next week at the Federal Reserve. From your perspective, have we downgraded the outlook for global growth for earnings to the extent we need to?
Well, I would say President Lagarde mentioned several times that they were normalizing, not tightening. And I think we're going to hear a similar message coming out of the Fed. They're walking both central banks are walking a very fine line here. I think, people are worried about stagflation. I think to a certain extent, we already have stagflation. And, both the ECB and the Fed are aware of that. And I think that we're going to hear a normalizing, not tightening message from the Fed as well. And I think we can expect probably fewer interest rate hikes than people were projecting, just 3 or 4 weeks ago.
Looking at the opening bell about 3-4 minutes into this, the S&P 500 down a little more than 1%, top of the pile. We've got used to this story, haven't we? Up 1.6%. The energy names advancing early in the session. Looking at crude right now, Brent and WTI, both of those up by almost 5% on Brent to 116, on WTI up 4% to 113. Just quickly, Luca, that inverse correlation between the euro, weaker again today in the face of this conversation, and Brent higher. How much of a problem is that going to become for the ECB this year? Not sure that Luca Paolini can hear me, so we'll move on to Mike McKee. Mike McKee, you and I can have that conversation another time. Talk to me about CPI in America, Mike. Never mind CPI in Europe and the outlook from this ECB.
Well, there are some similarities because CPI in the United States is showing inflation just as bad here. Well, actually worse in a numerical sense. To get the historical comparison right, since Madame Lagarde said it's all about the war, Leonid Brezhnev was the head of the USSR the last time inflation was this high in the United States. Headline inflation, 7.9% on a year-over-year basis, core 6.4%. And that is not good news for a Fed that has to figure out how it's going to handle that while at the same time worrying about what happens with the economy. Here are some of the biggest movers. Apparel was up 0.7, food 1%. Biggest thing was gasoline up 6.6%. And at this point, I have to step back and say, look, this was February before the war started, basically. So we're going to have more inflation in March. We just have to wait and see what happens. Now, the Fed knows that, too. do. And they also know that some of the things that we had seen go up post-COVID will start to go down. Used cars were off in price. So they're going to be watching this. They're going to be watching inflation expectations to make sure they don't become unmoored. And the problem is, if you look in the lower right-hand corner there, you can see market expectations for prices over the next 5 years for the first time in a while are starting to rise a little more significantly today after seeing this data. And so the Fed has to act. They're going to raise 25, but it doesn't totally take 50 off the table in the meetings after.
Mike, can you talk to me about the inflation outlook of the Fed? Bill Dudley, formerly of the New York Fed, called it Fantasyland a number of months ago on Bloomberg Surveillance. The PCE forecast for 22 is 2.7%. Then it drops to 2.3, then to 2.1. Interesting just looking at the ECB outlook for inflation, 5.1%, an upgrade to this year, or a downgrade, depending on which way you look at it, but certainly a lift to the forecast, 5.1 versus 3.2. Then 1.9 in 2024. Mike, what is it about central banks that just keep on saying, we'll get there, we'll get to where we need to get, and they always just pin that into the forecast?
Well, in their defense, and somebody has to defend the Fed once in a while, that forecast was made in the first part of December, and a lot has changed since then. There was no war at that point. So let's give them till next Wednesday when we get the decision and we get the new dot plot and the new forecasts. So we'll see if they raise their inflation forecasts and by how much. The interesting thing is Bloomberg's survey of U.S. forecasters for the month of March just came out, and PCE inflation, which is what the Fed will make a forecast on, is scheduled to be 5.4% now for the year. Will the Fed go that high? They haven't in the past. It's going to be interesting to see if they agree with what market anticipation of inflation is.
Mike McKee, thank you, sir. One name I want to look at, 7 minutes into the session, Amazon up around about 4%. Certainly not in line with the gains we saw after the close yesterday. I think we were looking for a bigger pop than that. The opening bell, about 8 minutes behind us, we advanced 4 percentage points. A 20-for-1 stock split, a $10 billion buyback. Does the stock split matter? You know my views on that already. But this is what Morgan Stanley had to say, more symbolic than material. And on the symbolism, the analyst community seemed to believe that perhaps this is a tilt to a more investor-friendly stance and away from the big monster capex cycle of years gone by. Perhaps the stock up by a little more than 4%. Emily, I want to come to you on how corporate America deals with the inflation story that Mike McKee just described. Margins were great through 21. Can that story continue through 22?
I think we're going to see significant margin pressure. And one of the part of the market that I would argue is the most defensive are going to be any companies with significant pricing power and that aren't going to succumb to or not going to be affected as much by higher input costs. So yes, I think margins are inevitably going to be under pressure. You know, we've got high input costs, not just in energy, but in all sorts of commodities that are coming out of Russia. Look at neon gas, neon, which is a critical component in manufacturing semiconductors. So it will reverberate across the economy, and there are going to be very few companies whose margins will be immune to
Emily,
that.
Luca, stand by. We're going to work through the situation in Ukraine in just a moment. The S&P 500 down by a little more than 1%, on the Nasdaq down by 1.6%. This after some monster gains yesterday. The biggest one-day pop on the S&P going back to June 2020. On the Nasdaq 100 back to March 2021. So we come back again, down by 1.6%. Seemingly the story of the morning. No diplomatic breakthrough whatsoever between a meeting between the Ukrainian foreign minister and the Russian foreign minister, just going by the headlines we got from that. And an urgent call from Chancellor Scholz alongside President Macron to President Vladimir Putin of Russia, pleading, demanding for an immediate ceasefire. No breakthrough there either. But what we have seen every single day, day after day, another company joining a long, long list of companies pulling out of Russia. Abigail Dillittle, the latest on Wall Street, please.
Yes, we did have a breaking headline right around 9:05, and it was based on Bloomberg exclusive reporting Goldman to exit Russia in Wall Street's first pullout. So in other words, Goldman is exiting its business in Russia. The first big bank to do so, the company saying Goldman Sachs is winding down its business in Russia in compliance with regulatory and licensing requirements. We are focused on supporting our clients across the globe in managing managing or closing out pre-existing obligations in the market and ensuring the well-being of our people. This means, importantly, John, that the firm is still trading corporate debt tied to the country, but without itself as a principal making bets on price movements. They are a market maker, and they are also helping clients to reduce their risk in Russian securities. Now, Goldman, of course, earlier this year, or this month, I should say, began to move its Moscow-based staff. The question, John, here is, will other banks follow? Citigroup, of course, is assessing its operations. It has the largest presence in Russia of any U.S. bank. Goldman, again, acting as a trailblazer, the first to leave Russia. The stock down a little bit, in line with markets lower today, despite the fact that yields are higher, John.
Abby, thank you. Coming up on the program, Russia and Ukraine making little progress in high-level talks.
We agreed to continue efforts to seek a solution.
That conversation still ahead.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali, sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Narrative that he conveyed to me is that they will continue their aggression until Ukraine meets their demands. And the list of those demands is a surrender.
Diplomatic talks between Russia and Ukraine delivering no breakthrough. The Russian Foreign Minister Sergei Lavrov sticking to the Kremlin script and saying the following: "We want a Ukraine that's friendly and demilitarized, where there won't be a ban on the Russian language, on Russian culture, Team coverage starts right now on both sides of the Atlantic with Bloomberg's Maria Tadeo and Anne-Marie down at the White House in D.C. Maria, first to you. The talks lined up in Turkey, the foreign ministers from Ukraine and Russia, and seemingly no breakthrough.
Well, there is no breakthrough. And Jonathan, I was watching that press conference of Sergei Lavrov, the Russian foreign minister, and to me, it was like watching a press conference done 2 weeks ago before the war started. He repeated the same talking points we've heard now for months for Russia, that they don't want to attack anyone, that going into Ukraine is a special operation. This is not a war. It was a preventive move. He also said that now in the territories, quote, that Russia has liberated in Ukraine, they have proof that the United States and Ukraine were working on biological weapons. He reiterated Russia has goals to comply in Ukraine. And then, of course, you had the Ukrainian foreign minister, Dmitry Kuleba, saying essentially this was the same old story that we've heard repeatedly. What they want is a surrender from the Ukrainian government, and that is not going to happen. And Jonathan, you have to put your headset and your mind in the perspective of the Ukrainian people. They really feel that this is a war that they can win. There's a huge spirit in the country of continue to fight, and resist. So for the time being, there is nothing that indicates there is a diplomatic breakthrough in sight.
AMH, the pictures that came out of Mariupol yesterday were deeply disturbing, incredibly upsetting, and we're all seeing this play out in real time. There was a conversation in financial markets about so-called peak sanctions. I wonder if the pressure builds even more so, not on the Americans necessarily, but on the Europeans, to push further on this, and perhaps the White House pushes them to do so, given that these pictures, right now at least, are a daily occurrence.
Jonathan, that's exactly right. When you see pictures like we have coming out of the city of Mariupol, when we have bombs on a hospital that had a maternity ward, there is pressure now building to really top heights on this administration and capitals in Europe to inflict more pain on President Putin and those that surround him. We already saw a move very early this morning from the United Kingdom going after 7 individuals close to President Putin. Roman Abramovich is one of them, Igor Sechin, another one. And then also, Jonathan, here at the White House, we had a Bloomberg story yesterday, a scoop that they're also potentially going to sanction one of Russia's, the biggest atomic energy company. So you can see they are looking at other ways to continue the pressure on the Kremlin in hopes of potentially trying to bring these Russian troops back and stop this onslaught on the Ukrainian people.
Anne-Marie, there's a domestic story here, of course, as well, and we need to talk about it. Secretary Granholm yesterday faced down oil producers in America and is pleading with them to produce more. We're at a point now where the US government has to think about incentivizing that, given that the price at the moment isn't a big enough incentive for them.
The price at the moment isn't a big enough, and a big talking point at the White House is the fact that they have these 9,000 unused leases, but clearly these companies are not using them at the moment. So potentially, Jonathan, that is something that they need to think about. How are we going to get domestic producers to want to engage and drill more? Because obviously taking out Russia's economy, and this is a massive commodity producer across the board, you are going to have elevated prices for a while. But Jonathan, we should note the administration is trying to explain this to the American people, and they are using this tactic, and they are blaming this all on President Vladimir Putin and his war on Russia. We have seen very much so prices spiking because of that. But we should note, in August, the administration was talking about the fact that oil prices were higher and were calling on OPEC. So this has been a problem in the administration, in America, in other European countries as well, in consuming countries. They were all going to be dealing with higher oil prices this year.
AMH, thank you. Anne-Marie in DC. Maria Tadeo, just fantastic work over the last few weeks. We appreciate your time as well. Emily Hill, Luca Paolini, back with us. Emily, I want to come to you. You talk about leaning towards high-quality value. Is this just about making it not complicated? Keep it simple, maximum uncertainty for the time being at least?
No, we've become much more bearish on 2022. So the reason to be defensive is because, frankly, I think that this geopolitical issue, which we know historically the markets don't react to geopolitical issues, and they in a substantial and prolonged way. But this problem is not going anywhere. We're dealing with a person, and I will confess that I am very surprised that Vladimir Putin made this massive a strategic blunder. I think he underestimated the West. He underestimated democracy, which he's very disdainful of. And I think he knows now that he's made a very substantial mistake and he's backed into a corner. And so I don't see an end point to this. And unfortunately, when we see spiking oil prices, historically, there is a very strong correlation between spiking oil prices and recessions. I think that correlation has broken down a little bit over the last 15 to 20 years. But the reason to stick with high quality companies with pricing power is that's where you're going to protect portfolios.
We are slowly unplugging one of the biggest commodity producers in the world, on the planet. Companies are pulling back. We potentially could face, Luca, a credit event, a default, a sovereign default. At the same time, we're pulling back QE. It's finished at the Federal Reserve. At the ECB, they're looking to wind that down by Q3. I'm looking at Italian 10-year yields at the moment, Luca, up 20 basis points, just short of 190, 186. For European banks, UniCredit down another 6 percentage points, SocGen down by 5.5%. Luca, that was such a consensus view coming into 2022 by the banks, by Europe. Things can change for ECB rates. Luca, what do you do with the European banks now, and how much of a risk is building on the continent?
Well, let me say that the call on European banks was based on the assumption that European growth would be very solid. And when you have, inflation, what it is going to be probably close to 7%. You're going to have, obviously, the impact on confidence, consumer business confidence from the situation in Ukraine. Well, you have on one side the direct impact of Russia, but also the impact of weaker growth. And banks were actually, as you rightly say, very overbought just a few months ago. I still believe that if there is a resolution in Ukraine and Russia, I think European banks have upside. But at this point in time, the risk is simply too high. And so I think we have been reducing our exposure to financials in general. And obviously for Europe, the situation is even more dangerous. And I think you see the price performance. I think it's consistent with the picture that we are seeing. And I think it's difficult to see European banks recovering as long as there is a real risk, not only of a credit event, but also of a recession, I would say. I think it's very difficult to be optimistic in the short term for the sectors.
Oh, the outlook for Europe right now, incredibly difficult, incredibly tough. Luca, great to catch up, sir. Luca Paolini, Emily Hill, thank you to you as well. A difficult outlook right now with the sector price action. Here's Abby.
A difficult day for stock traders, or at least stock bulls, John, because we have the S&P 500 down more than 1%. Not surprisingly, most sectors are lower. Now, what's happening today is a reversal of yesterday and more in line with what we've had for the last several days, weeks. Oil higher, up 2.8%. Energy, the best sector. Then consumer discretionary up fractionally. It had been up higher, more so on that Amazon stock split. The optics of it helping out that stock, but consumer discretionary about flat. You can see tech, though, on bottom. Financials, the second worst. This as Goldman says that it's going to exit its business in Russia, the first bank to do so. Interesting to see that sector down with yields up slightly. As for the year, John, it's all about metals, mining, and energy. Those are the top sectors on the year.
Energy flying, crude higher again today. Abby, thank you. Up next, your trading diary.
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
26 minutes into the session, no diplomatic breakthrough between Ukraine and Russia. Equities back down again by 0.8%. The two industry groups that are in positive territory, energy one for the obvious with Brent and WTI advancing today, consumer discretionary as well. But Amazon is the story there after that stock split and that $10 billion buyback. That's the price action. Here are your trading diary events. President Biden speaking with President Erdogan of Turkey. EU leaders kicking off a two-day meeting at 11:30 Eastern. The US Treasury selling $20 billion of 30-year notes at 1 p.m. And we hear from the president again later this evening. From New York City, this was the Countdown to the Open.
The Omicron variant and the latest wave have an impact on not only consumer trends, but your business. And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari-sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we had mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fiero's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking, the bus was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venegold as an opportunity to leave that troubled home. Venegold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venegold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Venegold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Wiener Gold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is, when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.